Hello, everyone. Welcome. I see everyone logging in now. We're just going to give you all a second to get settled in, but welcome. I'm Lydia. I'm part of Team Hustle Fund. While you are all logging in, why don't you let us know where you're tuning in from? I know we have a very global audience for this one, and I would love to hear where you're all from. San Diego, Andrew, welcome. I am actually in Calgary, Canada, believe it or not. And if you don't know us yet, if you have not heard of Hustle Fund, we are an early stage VC fund and we invest all over. We really believe that great founders and great investors can look like anyone and come from anywhere. So we invest not only in the US, but we also invest in Southeast Asia, hence this audience, as well as Latin America, Africa, a few other places, and Canada, actually. Today, we're going to be having quite an event. It's going to be 3 different sessions with family offices from the US, Singapore, and Vietnam. So if you cannot stick around for the full 3 hours, not to worry, this is being recorded and we'll send it out right away. Wow, we've got LA, Milwaukee, a lot of US tuning in for Dave. All right, I got y'all. Before I go on to introduce our speakers, I wanted to just paint you a picture. If you're looking at your screen and you're like, this is nice, but what I would really like to do is sit on a beach, listen to the waves, drink on a tropical cocktail, and at the same time, be talking to world-class people who also happen to be investors, maybe VCs, angels, family offices. I would like to be doing all that. Then I do have a solution for you. It's our 3rd Hustle Fund, Camp Hustle, presented by Hustle Fund, and is going to be taking place in Bali in September. So if you're like, this is amazing, and I would like to do more of this in person, then join us there. I'm going to be sharing a link to the event, and we're actually giving a special discount code for everyone who's joining us today to have a hefty discount on your ticket. So look out for that in the chat. I'm going to paste that in. Do you hear that, Eric? Our GP Eric is on with us. He's going to be interviewing Dave Sachse today, and they're saying, Eric, your garage game is legit. So you know what, Eric? Take it away.
Karen, thank you so much. I feel seen and heard. So I very much appreciate that. My name is Eric. Thank you so much for that, Lydia. I'm one of the co-founders here at Hustle Fund, and I am delighted to kick things off with this first topic, which is how to start venture investing in the United States as a family. And to do that, we're joined by an amazing guest, Dave Sachse. I'm going to have him introduce himself in just a moment, but I want to throw a little bit of structure behind this conversation. So we've prepared about 25 minutes of questions to grill Dave in the hot seats to learn more about some of his activities, how he approaches this space. And then we have reserved about 30 minutes thereafter to open it up to you. So if you have a question, please go ahead and put it in the Q&A section of this Zoom webinar. And my incredible colleague Lydia is going to come back to the screen and help us to moderate some of these questions as they come in. So be prepared for that. Ask your questions in the Q&A. Let's go ahead and get started. Dave, before I cede my microphone to you, I have this obsession with trolling people that I really like. And it just so happens that I
already know that.
Like
I know that, by the way.
So let me share a couple of fun facts about Dave Sachse. First and foremost, he is a software founder, but you may not know he's also an occasional butcher behind the meat counter of his local grocery store. That is true. Go visit him during the holidays and ask for that Christmas ham. He also happens to be a hardcore Milwaukee Bucks fan. You may have seen a selfie of his with a freak t-shirt. He seems to be obsessed with Giannis for good reason. And it turns out he's also a pretty damn good short game golfer. So if you follow him on Twitter, that's DSOX. I highly recommend it. On occasion, he's going to share some chip shots where he's just nailing him like you know, candy stealing baby, all that kind of stuff, right? I'm impressed as a struggling golfer myself. And oh yes, he also is the managing partner of the Sachse Family Fund, which focuses on direct investing, and the managing partner of Family VC, which is a unique community of investors that are collaborating on venture capital. So Dave, welcome to this session. We'd love to learn more about you in your own words, and maybe even also a little bit more details about how you split your activities with the Sachse Family Fund as well as Family VC.
Yeah, that's great. So Eric, thank you so much. And Lydia as well. Thank you to the entire Hustle Fund team just for including me here. Happy to and excited to talk about all things family offices and investing. But yeah, real quick. So I'm Dave Sachse. I'm based in Sheboygan, Wisconsin, about an hour north of Milwaukee. So I'm in the Milwaukee area in Wisconsin. I do venture investing out of my family's family office. I do that out of a fund called Sachse Family Fund. And that is a pre-seed to Series A venture fund where the only LPs are family members. Additionally, I've created a community, some would call it a syndicate, but it's a little bit different than that, called Family VC, and that's a network of over 100 family offices that collaborate on all things venture investing. And and it's been a blast doing this the last 7 years, 5 years full time, and I just feel like it's quite the learning journey to constantly learn and meet great investors like yourself and savvy founders as well.
So let's talk a little bit about Family VC for a moment here. Why create this? Because it's unusual to see, I think, a family office, managing partner to actually go and try to go with a communities approach. What was the thinking behind that?
Yeah, so the thinking was, I quickly learned, I think it was in like year 2 or 3 doing venture, I quickly learned capital is a commodity. So, and then to put it in perspective, I looked at over 500 venture funds, and to me, 95% of them sound very, very similar. And it only reinforced that capital is a commodity, and it made me look in the mirror and say, why would anybody want to work with a random family office that nobody knows of, regardless of where I'm based? And I know capital is not the answer, and other people's capital is a weak answer. And so I leaned in heavily here to the family office hand I was dealt, and decided to create a community that I call Family VC. And not only does it have investors, but it also has connections to customers, distributors, as well as other strategic partners that I've leveraged here for portfolio companies, as well as due diligence. So it's been great process to truly create like a community of value that can bring more to the table to both VC funds as well as startups. That's more than capital.
Highly recommend that folks check out familyvc.com. You can see their landing page there, and there's a membership here, so you can go ahead and apply if you're running a family office and are curious about this community. All right, so those were the softball questions, and I want to make this way more awkward. So here we go. Did your family get rich off tech, and or do you consider yourselves to be outsiders from when it comes to Silicon Valley?
Well, so we didn't get rich off tech. Now, tech was some tech companies were customers of some of the products that my family made their wealth in, but it was really 2 core products. It was in a manufacturing industry, but we made 2 core products at the company where my parents made substantial liquidity event, and that was frozen ice cream machines that went into Midwest fast food locations not named McDonald's, so nobody come with me with flurry complaints. And then also industrial washers that wash things like Intel's computer chips or Disney's 3D glasses. So we had customers that were in the tech space, but we were nowhere near understanding the tech space from being kind of on the ground floor.
So it sounds like a lot of manufacturing experiences are based in the Midwest, which is not considered one of the traditional tech hubs, although that's changing a bit. So it seems like an outsider status. You're with a Sachse Family Fund, as mentioned, oriented towards pre-seed and seed investing, which is a really aggressive category, really early, tends to come with a lot of players who have ostensible deep expertise as software founders themselves or other kinds of tech backgrounds. A lot of these folks are actually based here in the Bay Area.
Yep.
What attracted you to actually this segment when you're setting up a fund?
Yeah, great question. So why early stage? I looked at it as why not. When I came into my family's family office 8 years after, or 6 years really after it was established, I realized we were investing in all the asset classes but venture. I looked at it as an opportunity instead of a weakness. And yeah, ultimately, it comes from my background as well. My career, I started out as a product manager in the corporate world for software. And that was in 2008 when I started, and I was tracking the venture industry from that point on. And additionally, after in the early 2010s, I tried to run my own high growth startup and ultimately had a lot of tough learning lessons. But I came out of that wanting to be the VC I wish I had, essentially. And that took years to develop. But once I got resources and the means, that's what intrinsically motivates me. But then outside of that, early stage to me has the highest return potential as well. I mean, venture is a very risky asset class, and especially early stage, but it's also a great opportunity for huge returns and outlier returns. And that's why we lean more on early stage versus later stage, where the multiples are a lot less, and we can get those in other asset classes that we're already allocating towards.
So I'm being a little bit mean towards Dave, but he is actually a software founder himself. So there is a little bit of context, I think, in terms of the activities, and you're probably applying that in terms of how you're questioning founders and doing your diligence, drawing from those experiences. Sure. But there's a couple of interesting dynamics, I think. I'd imagine when it comes to being the managing partner of a family office. You mentioned that your key LPs are other family members, which is not unusual in family office dynamics. Can you tell us a little bit more about the decision? So if you're talking to a young buck named Eric Bond, you're like, I want to take a chance on this like AI startup that merges Web3 and AI topics and AR and VR. You might actually have some of this expertise because of your background, but I imagine different family members come from different perspectives as well. Maybe some are more manufacturing oriented or some other kind of components, aspects of the business. So what does alignment look like when you're trying to make a decision to invest?
Yeah, so I'll back that up and also explain that, like, I'm Gen 2, and meaning the Gen 1 created the wealth. I'm Gen 2, but we also work with like my uncle and aunt who made their wealth in another area, retail. But what I'm getting to is a lot of us were extremely, extremely new and green to early stage venture. So we took a learning journey approach. It was a crawl, walk, run. It's not like I had a family to dinner and they're like, yeah, let's do this venture investing. That sounds great. No, it was over like a 2.5 year process of consuming content, seeing a lot more high volume of deals through accelerators, through AngelList, through other stuff, to eventually create more of a thesis on why we should do venture more as a group. Because what we did is we really started out individually. Like I started with my wife, just angel investing, and then we moved to angel investing with the family members as like a quasi angel group, and everybody got to make their own decisions. And then we eventually moved, when we wanted a pool, then we moved to Sachse Family Fund. So that was a step process that took almost up to 3 years. And yeah, I think one of the bigger challenges too, and I see it with a lot of family offices, is the older gens, if they didn't make their money in tech or aren't well versed in venture, they often look at it with a private equity lens. So it's challenging if and even legacy VC is done differently than what I would call modern VC. So what I did early on is just would feed a lot of my family members different content from the industry, including Hustle Fund. Thank you very much for you guys getting on the scene in 2017, 2018 there. So, but I would slowly feed them that content. And then we eventually created a vision and a thesis around our fund. And that's ultimately how we ended up launching a fund. But to create alignment, I mean, it wasn't easy, because having the private equity mindset, I mean, early stage venture is especially illiquid. So when we went to create like a fund and a pool of capital, like we put out like strict, hey, this capital is gone for 10 years. We can't call it back. It's gone. We're illiquid. And, setting that kind of ground infrastructure right off the bat made everybody better understand the risk, return, reward profile, and knowing that it's a lot different than these other asset classes that we invest in.
I want to come back to a comment that you made, which was related to the inception of some of the structure behind this family office. You said that, you noticed that capital is a commodity. And I largely agree with that statement. Maybe less so in this economy, but like at least in the last few years, that's been very true.
Yes.
I want to just like call out something I think that you really understood well, this was apparent in our first conversations together, which is that may be true, but perspectives are not. And I often, and you may actually encounter this with some of your family office members in family VC, which is, they may have made their wealth in a very different kind of industry, manufacturing, oil and gas, whatever it is. And it almost feels like a little bit of self-selection or imposter syndrome of like, well, I'm an oil and gas person. So, do I really have a voice to play in supporting Silicon Valley companies?
Mhm.
And what I really like, I think, about your perspective, it seems like your overall mission is like this notion that, we should be adding more perspectives in this industry. And I think this is actually the really important thing about why it's so exciting for founders to work with you, which is there's a lot of myopia. If you just look at the 7-by-7 mile San Francisco city limits where a ton of capital is being concentrated, we're kind of like building for ourselves. We want to create Uber for pets and all that stuff. But I think someone that comes from the Midwest, a little bit more of a distance from that, but also like arm's length, because you've been into space before as a founder. That's something to celebrate, which is that different perspective. And I guess like for those family offices that are listening to us who may come from a non-tech kind of perspective, what is your onboarding like? Like, how do you sort of like pep talk them into gaining the confidence that they can participate in this ecosystem?
Yeah, I mean, for me, what I tell people is, hey, when you work with family, you're risking a lot more than just capital. So understand that when you're approaching family offices. And so it's not easy as people would think, like there's just a big money bank where they go and grab money to invest in startups. A lot of these people in family offices, whether they're family members or hired guns, they need to champion it internally. And it's really, really hard to do that if you're not doing it full time and really consuming yourself with venture. So, I mean, one of the biggest things that I encourage people to do is you need to work with people that are doing venture full time. And I'm not talking about wealth managers. I'm talking about actual VCs. And that will give you a lot of context on different strategies, deal flow, how they write memos, other stuff. And it can really help challenge your thinking and your thesis on many different things. But I mean, if I had to give advice for onboarding in family offices, I mean, the things that I would say is you got to be patient capital. Make sure you're not just getting too excited and throwing big checks down right away. Additionally, you want to create designated check sizes and not do investing off balance sheet of operating companies or anything like that. That can create a lot of conflict between the operating company and the family office and the leadership there, and it's very challenging. And so having a dedicated pool of capital is really, really critical. And then, yeah, a couple other things too, is at the end of the day, you want to understand your why. Why are you investing in venture? Is this for finding purpose for younger gen? Is this for outsized returns? Is this for finding innovative solutions for operating companies? Why are you investing in venture, and better understanding that? And then to extend off of why you're investing in venture, you want to understand what you want to invest in. And it's almost as important what you don't want to invest in, because the family offices often don't put themselves out there for many reasons. And I've learned that the hard way over the last couple of years. But ultimately, yeah, you want to have vetted deal flow that you want to look at and better manage the noise to signal ratio.
So wait, I want to touch on this one point here, because I think it's very interesting and not what I expected, which is what you align on what you don't want to invest in. What was your process like to get alignment of like, these are definitely sectors that we don't like?
Yeah, I mean, it was over time through experience, through bringing deals to the table, and like we realized hardware is super hard and we don't really have expertise or knowledge to do that. So we're going to stop looking at hardware. And then there was just categories where we didn't touch from the get-go. Hardware, medical devices, pharmaceuticals, bio life sciences. But then some of the other stuff, it was like I said, through experience and through seeing deals. We initially looked at a lot of ad tech stuff. Then I historically looked at just the ad tech space, how fast it changes, historical exits. And ultimately, we didn't have as much value add in the ad tech as I thought. So we stopped looking at ad tech ultimately. Another one was AR, VR. So my uncle, Peter Sachse, who helped manage the Sachse family fund, he had a 37-year career at Macy's. And in the 2010s, he was in the C-suite and he saw a lot of AR, VR stuff. Well, him and I see very differently on AR and VR deals. And I love my uncle very much. I enjoy golfing with him. I'd like to keep him as an uncle. So we just took AR and VR off the table because we didn't see eye to eye. And it was always contentious around why we should take a look at this or why it's a bunch of crap. So we just took it off. So that's how we iterated our thesis over time. And it was through seeing a high volume of deals. And that's why I was encouraging to be patient, and you want to start looking at a lot of deals, but be patient on deployment at first until you have a good grasp of your thesis and what you want to invest in, but almost as important, what you won't invest in.
This is amazing. I think like setting that kind of social contract too, which with their family, and reminding them explicitly, like, our love supersedes the returns. Therefore, like, let's just avoid anything that feels like a fight. That's really cool. And I don't actually hear that named very often with some of the family offices that we've had a chance to get to know as well. Okay.
Well,
just
Eric, on that, I just want to add to that. You know, a lot of people don't understand that a majority of family offices, they either operate as a family or they operate as a business. Not a lot of them do it well, both of them well. So actually what I do, and I optimize for family continuity and harmony in a lot of the stuff we do, especially in the stuff that I'm leading, which is VC. And I think that's very important, but I also see how pretty rare that is in the family office world for many other reasons we won't get into today.
We might get into it in the Q&A. Just wait and see. For those of you who may have joined us a little bit late in the conversation, we're speaking with Dave Sachse. He is the managing partner of the Sachse Family Fund, which is a direct investing entity into early stage companies, tech startups, as well as he is the founder and managing partner of Family VC. Check it out at familyvc.com. It's a really great community for family offices to network and collaborate together. So I have 3 more questions, and then let's pop over to the open Q&A in just a moment. If you have a question, by the way, please put it in the Q&A section. I already see one coming in from Martin, and we will have about 30 minutes at the end. So this is a self-serving question.
Okay.
But you kind of raised it in a little bit of a way. So what role does LP investing into venture funds play into sort of your deal sourcing as well as your learning? And what's the right amount? What's too much? What's too little? I mean, if you're a new family office going fresh and you have these thesis areas that you care about, you know, LP investing seems sensible. But I mean, what was your entire approach in terms of how to balance that? Because you seem to be a direct investor at heart.
Yeah, I'm a direct investor at heart, but remember what I was saying is we didn't have a formal background or experience in the space. So essentially, I paid for it. I paid for investing in different venture funds, not only because I believe in the people and I think it'll be a good return, but more importantly, I wanted to see different strategies, different operations, different approaches to diligence, investment memos, different approaches to how they treat LPs and all sorts of stuff. And almost as important is boots on the ground in different geos, because being in Wisconsin, I did not want to limit myself to any geography or hard, fast rules around venture investing. It's hard enough with the way it currently is. So yeah, so a big thing for me was ultimately, you know, want to make sure that I have people in other ecosystems that if I see a deal that's in Tampa or Miami, I know people that can do a proper background on some of the people locally, and so I can get the true story and I don't have to try to do it over a 30 or 60-minute Zoom. And that's really important to me, because most of our direct investing is early stage, which is pre-seed or seed. And as you know, Eric, there's not a lot of information there. So where you can, getting both the quantitative and qualitative is super important. So I did it for a variety of different reasons, but I will say it's helped me immensely from a learning and networking standpoint, that I wouldn't be where I am today without teams like yours, Eric. And I know you're self-serving, but several other teams as well. And not just ones that I've invested in, several that I've come across that certain timing with stuff that was going on personally or other stuff, it just wasn't great timing, but I still have been influenced and educated by a lot of these VC investors, and it's only helped me level up my game.
I think there's a ton of GPs here who are interested in these questions. I'll ask sort of a clarifier, and this actually relates to our relationship. So obviously me and Sheehan are very cool people, right? But let's talk about
what about Elizabeth?
Like, how did you what were your heuristics that you're looking for to realize that, like, what if she was like a crazy a-hole, or you know, like when it comes to LP investing, I don't take that very trivially, because not only is it a very big responsibility for the GP to steward your family's success, but also you're married to us for at least the next 10 years as we play out the life of this fund. That's a long time to deal with either egos or weird personalities, but also maybe even like a fun thesis that you realize like, oh my gosh, I don't believe in this at all. How did you sort of like sort that noise too?
Yeah, I mean, it was a process for sure, but ultimately, how I sorted it was getting a better grasp of what we wanted to do on our fun side of things. But looking into the people that we wanted to work with, there's a reason I listed the values out, and it sounds corny, and I know there's a bunch of like fluff content online, but the values that are on Sachse Family Fund's website are true family values. And the reason I put them out there is to be brutally transparent on how we operate and what we're about, because as I said, when you're working with family, you're risking a lot more than just capital. So that's a big thing. But one of the biggest things for me is, other than value alignment, is understanding their why. I think a lot of people get surprised when I ask why they're doing venture, and they say LPs haven't asked us these types of questions. When you probe into the why, on why are they truly doing venture right now, and what is motivating them to keep doing venture, especially when it's not sexy in macro environments like this. When you start probing on questions like that, you really start to understand what are motivating people to do what they're doing. Lastly, I look at it where people that we invest in, whether they're founders or investors, I look at it as, do I want to work for them? Will I pick up their phone call on my worst day and help them out? And that's a big litmus test. And using my bullshit radar as well in my poker read, I usually can peel back the layers pretty quickly to understand, hey, is this somebody that's going to want to collaborate, and are we aligned in values, or maybe not. So that's a lot of the thinking that we go through to understand how we want to partner with people, on top of all the other things that you would think of, like, hey, is there co-investment opportunities? What's your strategy? That's some of the basic LP questions that you ask, but more alignment of values and people is what's really important to me.
Highly encourage the people who are listening to check out the SachseFamilyFund.com. There's a section called Our Approach where you can see their values, and it's really cool to see that explicitly listed. And that's something that gave us a lot of peace of mind too when we decided that we're going to try to collaborate together mutually. Okay, two more questions really quick. The first one is, you're weird in the sense of a lot of reasons, but like in this one sense, which is just like a lot of family offices don't want to have a public profile, right? There's a lot of information attack that happens to your inbox, a lot of attention, a lot more noise. And so we've met our fair share of family offices that want to remain anonymous. And some of them we're like, stewarding enormous assets as well. Yet you've taken the approach of leaning into content, branding, community. Tell us a little bit more about that choice too, because that does set you up to be a little bit of a spammy target.
Yeah, and like I was referring to earlier, I've learned that the hard way over the last couple of years since I've had the Sachse Family Fund website. And I understand most families, they don't want to have a website, because if they don't have somebody managing that asset class that they have a website on full time, the signal to noise ratio is almost not worth even checking out. I mean, personally speaking, when I got a website for Sachse Family Fund, I can't tell you how many random investment requests I got that were nothing to do with venture. I mean, this was airline business, movies, all sorts of stuff, timeshares, nothing that I really wanted to take a look at. But, another big reason why I put myself out there is I want people to have context on who they're working with and who they're taking money from. Because to me, due diligence is a two-way street. And as I said, when you're working with family, you're risking a lot more than just capital. So I like other founders and VCs to have context on me, not just as an investor, but personally. Obviously, you've got a list of stuff that you can tease me about, but I like being able to personally relate to people. That's why even with family VC, I travel all over and break bread with family offices over a casual meal, just to get to know people and better understand their thesis and what they're like outside of work and what motivates them. Because at the end of the day, you work with people you like and trust. And to me, nothing creates more trust than transparency. And I'm trying to be brutally transparent, sometimes maybe to a fault, but I feel like that will pay off for me in the long run.
Absolutely, man. Amen to that one too. I can attest to that, the transparency. Okay, my last question to you, and we really should open it up to some questions for the
Yeah.
remaining 30 minutes. Again, if you have a question for Dave Sachse, please put it in the Q&A section, and my colleague Lydia is going to come back and help us moderate some of those questions. You mentioned the fact you're generation 2, and I know for a fact you have a lovely generation 3 that you're rearing as well. I'm curious about, what are your hopes and dreams for them when it comes to some of these activities? Like, is there something they're trying to set up for them or something they're trying to teach them in this family business that you're running?
I want to teach them that anything's possible. I mean, I grew up in a very entrepreneurial family. My great grandparents had a retail store for over 100 years.
Hmm.
My father and mother were constantly chasing different entrepreneurial endeavors. My aunt and uncle had a restaurant. I had a window washing business in high school and college. And I was very entrepreneurial in college, but I still, after I graduated, I had the mentality to go work for the corporate and climb the ladder until I get CEO in 20 years. And that was my mentality. So some of it, I want to help them envision or create what's possible, because anything is possible if they use their imagination and creativity. But on top of that, these investments that we're doing now, not only do they create networks, but they create education and learnings, sometimes specific to an industry. I mean, if our family's heavy in manufacturing and retail, my son's asking me how he can make games on Roblox so he can earn money from other users. And like, hey, I don't have that, son, but guess what? I got a lot of smart friends in the industry that know that. So I'm going to ask them. So it's really exposing them to what is possible, but then also really leaning into what we call one of our sayings at the Sachse family household is try your best and forget about the rest. Anything my kids do, I want them to have one gear, and that would be give everything at what they do. But I want them to know that they can give everything to anything that they want. They just have to work for it.
I love it. Well, this has been a great conversation, Dave. We could have kept on going forever, but Lydia, if you're there, I know that there are some questions that are coming up from the audience, and now is a perfect time, if you've been listening to this conversation, to put your question in the Q&A section. And Lydia, are there any compelling questions to kick this thing off with Dave?
Yes. Well, what an amazing conversation, Dave. So good to know more about you. I know that Eric is so good at asking the difficult questions that we all want to be asking. So there's a question from Martin, and I know we covered a little bit of this, but it might be worth clarifying. He says, I have seen most families doing venture in later stages and through brand funds. How did you get comfortable in the pre-seed stage?
How did I get comfortable? Meeting people like Hustle Fund, but more importantly, approaching the asset class with portfolio construction. So going back to not getting caught up in slapping down heavy big checks right away, or a few big checks, which I've seen people do across many different stages. But then also was a little bit was out of necessity, because if I went growth stage, my family would look at me and say 2 to 5x, we're doing that in other areas. Why should we do that here? And so part of it was out of necessity. Part of it is also I enjoy the early stages of creation. As a former entrepreneur, tried doing that myself. I like being in the trenches and helping out when not a lot of people believe in what you're doing. And many of the reasons like that really drove me towards early stage. Ultimately is where I like to play.
Amazing.
Kind of actually, it might be interesting to talk a little bit too, Dave, about our history. I think we found each other because of Twitter.
Probably, yeah. The
right.
Bird Group has been super helpful to me, meeting VCs like yourself, and putting my chip shots out there and my my Bucksaholic fandism. So yeah, it's all good stuff. But where were you going with that question?
I guess I was going with this because it's slightly orthogonal to the question being asked, but this is actually around this concept of transparency. What I've always appreciated about Dave's brand is it's irrefutably transparent. I mean, like it's almost like a direct line of like from his neocortex right into Twitter sometimes. It could be things around like, what am I doing with my family, or enjoying this game with my kids, or it's like an insight that you're having in terms of tech or investing in some form. And I think like where we kind of became professionally attracted to each other was the fact that we also approach our Twitter in the same way.
Mhm.
So like I really credit Elizabeth for leading the charge on this. She's not an a-hole, it turns out. She actually is the most authentic and direct person that I've ever met, and is really lovable as a result. And if you follow her on Twitter, for those in the audience, I really encourage you to do so, because she just really puts it out there. But I think there's like something I learned in like psychology class. Like this is like when I was single, and like I was like, when am I ever gonna like find a girlfriend? And then it was like I think the teacher basically says, like, in nature, like begets like, which is like those that can find each other with similar values or maybe even phenotypes, like they tend to be
Mhm.
more attracted to each other. So, I guess I thought this is not quite the question that was being asked, is just like, if you put yourself out there as authentically as you represent yourself as a GP, that I think can attract LPs who share those kinds of similar values. But if you're an LP also listening, this also works with founders too. So like if you're trying to attract a very specific kind of founder who can appreciate like very high EQ, and maybe you really put it out there in the terms of the types of deals that you like to do or sectors that you want to support, don't be surprised if you actually can quickly develop the brand to actually find some of those direct opportunities with those founders or those GPs, whatever you desire. I don't know if there's anything else you would add to that, Dave, but I just seen you do this so well.
Yeah, I mean, so something that attracts me to VCs on Twitter that I've seen, and something that the Hustle Fund team has done well, is how you treat founders, especially the ones that you say no to. Everyone will be happy if you give them cash, like they'll be your best friend for a week or something. But like it's those people that you say no to, and yeah, it's through funds like yours and several others that I've learned on how to operate in treating founders, that you have to say no to, and that's not an easy thing, but it was values like that attracted me. So when GPs are putting themselves out there, like I don't care about politics or MBA or like commentary, I care more about how they think as investors and how they treat founders. So like Hustle Fund does a great job of doing that, and that's definitely what helped me gravitate towards your team.
I'm insulted that you're implying that you don't care about my F1 commentary every weekend. So I'll
You know
just put
what?
that
I was
aside.
so confused why all these VCs started talking about F1, and then
Yeah,
like my wife's like, "Hey, it's on Netflix." I was like, "Oh,
yeah, exactly. Go watch Netflix, friend.
yeah." So
Olivia, let's bring you back before we get too derailed, because I'm going to get lost in this like sports conversation in a second here. Were there any other? What's another great question to pose to our illustrious guest today, Dave Sachse?
Yes. So there's a question about geography I thought we could explore a little bit. Vinesh is asking, what's your appetite for India? Do you do direct investments or happy investing into a fund? If the latter, how do we get in touch? So I think we do know how to get in touch. I've posted your website in the chat, but curious about geography, very international audience here. Where do you invest? And do you do direct?
yeah, so we do direct. Primarily, it's only been North America to date, but that has been a weakness only because I haven't had a significant network of funds in some of these other ecosystems. I have seen some amazing deals in India, from LATAM, from Europe, but I just haven't pulled the trigger on them because back to what I was saying before, we didn't have some boots on the ground that I could do some background checks. And I don't do the, hey, signaling this investor's in, you get in type thing. No, I want to understand who these people are and who I'm going to be working for, essentially.
Yeah.
So that's really important to me. But yeah, I've missed some great opportunities because I didn't pull the trigger, because I didn't have locals there that would help me with the qualitative background checks that I was hopeful to get. But definitely open to it. And moving forward, I think there's going to be great opportunity in a lot of different ecosystems globally here. And I'm definitely going to be more open to it. And I'm trying to aggressively expand my network in some of these other ecosystems so I can fill some of those gaps and truly consider those deals instead of passing on them.
Beautiful. And I think you just got a volunteer in the chat, Allie, saying happy to help with diligence in LATAM. So there you go. All right. Well, we've got another question I thought was interesting. What are your expectations for GP LP communications?
Oh boy, expectations. Well, I guess what's communicated or marketed before you write the check versus what happens after is an interesting scenario. I would say at the very minimum, if you're not doing quarterly, it's definitely a disservice to your team, whether it's for future co-investments, for supporting the portcos, or considering co-investment opportunities as the companies progress and you can't fill out your pro rata. It's really tough to not hear from anything for quarters a year and then be like, hey, we need you now. And you're like, oh, where have you been? And so, yeah, I would say at a minimum, it should be quarterly, but yeah, I think the best ones are transparent, even beyond that, by having an open door type policy.
I'd like to actually address some of that too on the GP side of it. So we do monthly, and with a quarterly also refresh on our data and our performance metrics, just like whatever's been audited. So I think there's like something that our team took really, really seriously when we decided to become venture capitalists, which is, look, at the end of the day, I'm going to just break it down very crudely. If you're a VC, you're kind of just like a fancy wealth manager, right? Like we're taking the wealth of families, individuals, institutions, and trying to turn it into more wealth. That's one major component of this work, of course, alongside of the investing and supporting the founders and so forth. But that's a critical lever. That's the former. And if you accept that, then you need to also realize that the people whom you're serving have families. They have kids, they have college educations, they have hopes and dreams as well as that they want to serve. And in venture, it's really interesting because like I never really see the words fiduciary thrown around in terms of the work that you do as a general partner, but the social contract is really clear. We are fiduciaries. We're trying to work in the fiduciary, the fiduciary responsibility, of the stewardship, I'm losing my words here, of the LPs that we're serving as well. And if you are going to be an LP, and many GPs are, what is your expectation? You want to kind of get a sense of how well the money is doing so that you have an expectation for your family too. So I think indexing towards over communication is always best. I think monthly works for us, but the real-time communication is also really critical. And what that means, at least within our team, is we generally will try to respond within 24 hours to any LP request, right? Like that, we just have to respond really quickly. That's true of all founders too, in our fund too. But speed, I think, is something that is really noticed and appreciated if you're going to build that trust. It's sort of like if I get into an argument with my wife, which never happens, then like she can't hear me through the garage doors. Then like, if she's like, why the hell did you do this thing? And I don't respond to her for a month, that ain't gonna work, right? Like I gotta get back to her pretty quick, right? Maybe
Yep.
she'll give me an hour or two to think about it. Anyway, I could blow the
I would add,
on.
yeah, I would add to that too. It's not only speed, but it's also substance. I mean, if you're at a family office and you're either a family member or a hired gun that is trying to champion the allocation to VC, you want them to be able to like successfully champion you. And if you're never talking about performance or fiduciary responsibility, and you're talking about the latest programs or VC trends or memes, you're going to lose people very, very quickly, because at the end of the day, they have a fiduciary responsibility, what they did, investing in the GP. So I think it's also substance too, Eric.
Yeah. Amen to all that as well. I see the questions rolling in now, Lydia. Do we have some more that we can post to Dave in the next 15 minutes that we have with him? Oh, I think she just logged off and said nope. Here, let me see.
I'm checking out the questions.
Yeah, me
here.
too.
I see.
I see one from.
Oh, go ahead.
Oh, so I was going to pose this one. The top of my list is actually one that relates to family VC. Pranav is asking, like, what kinds of events can founders what kind of events can founders meet family office VCs at? Oh, I think I'll start taking it a little bit differently. Let me actually so let me answer that question, and actually I'll ask you the question I thought he was asking, because for some of the family offices that are here. So Pranav, the answer is generally it's kind of hard to find an event that has a lot of family offices in attendance, but I have found a few. So if you go to like Ray's conference, I think that's really good. TechCrunch Disrupt, I think, is still quite good when it comes to bringing in like a large kind of segment of audience there. So I'd probably start with those, like Ray's and TechCrunch Disrupt. And there might be a few more here too, but there's a different kind of question, which is like, I kind of want to learn more about this wasn't asked, but I want to know now. For your community, are there events that you're hosting too for like the family offices within Family VC? Like what does that look like in terms of those meetups and that kind of support system?
So yeah, so the current events that I do at Family VC, usually it's leveraging off existing industry events that are around either VC or family office related. What I've only done to date is more informal stuff that doesn't have any pitches. In fact, I'm very particular on even sponsors. I told one sponsor one time at a dinner, if they talk too much, I'll stand up and say, I'm paying for everything, stop. So they know how I operate. And that's something in the future that I'm looking into on how to better essentially bridge the gap between the VCs and founders and the family office world, and how I can connect those. And I'm going to do that in a more formal way. I've been very guarded because a lot of these families have trust issues because they're constantly pitched stuff ad nauseum. So when they get offered a bunch of value without any pitches, they're a little confused, but in a good way. But ultimately, I don't have any like particular events yet that are like specific for founders or VC fund managers to pitch, but that is something I'm creatively working on.
We'll chat some more too, because we really love to put on the good events, and including Camp Hustle Asia, which is happening in Bali this September. Check out camphustleasia.com. Got to plug it.
Well, hold on. Yeah, great plug. And then I'll also say that I did check out a Camp Hustle here in the US. And last year's Camp Hustle, I invited like 10 family offices from Family VC. And that's an example of things that I do to then try to help family offices get connected to the ecosystem in events that I feel are going to be more conducive to them learning and growing instead of just getting pitched to like their sheep.
Yeah. I hear that. Thank you for that plug as well. Lydia, we got you back. Any other questions that are rolling in for Dave?
Yeah. Sorry about that, team. We are going to be asking a bit more of a theme question, I guess. Are you allocating anything to climate tech? And how do you see thematic focus like that one?
So I think thematic focus can be great for people that have the skill set, expertise, knowledge, background. I think it can be very, very challenging if you only have some of that. I'm not opposed to investing in funds that are more have core themes. As far as climate tech, I do think there'll be some great opportunities in the coming years. I personally don't have a strong pipeline of deals or deal flow channels where I get climate tech deals. I think I get all the adverse climate tech deals because a lot of them are more cold outreach. So, but I'm not opposed to climate tech. I just haven't been building great deal flow channels to really optimize quality deals.
Nice. All right. And it's time for me to ask a question that I think might be uncomfortable. So this could be fun. An anonymous poster is asking, really enjoyed your presentation, very relatable. Is there a minimum check size you typically cut for VC funds?
Yeah, I mean, so the first go around with Sachse Family Fund, I mean, we ranged in check sizes because we really didn't. If you recall, it was a 3-year process for me to get the family on board, and during that 3 years, I was slowly starting to invest in funds. So it's not like all these funds are in one vehicle or anything like that. In fact, they're spread out across like 6 or 7 entities. But yeah, how I look at it is like, historically, we typically have done anywhere from 50 to 50K to 7 figures. But moving forward, I'm working on my next allocation and my next act in venture because of the generational divide and age gap and my preference for early stage. The older family members were already in round 2 and they don't like early stage as much, and they realize they might not necessarily be around to see it come to fruition. So I'm figuring that out myself. But as far as where I'm going to go with check sizes moving forward, that's still TBD. But I will say I do try to have a balance of every dollar I put in venture funds, I try to put usually 3 to 4 into directs.
Beautiful.
That was awkward, Lydia. Thanks.
I know. I loved it.
That was awkward.
Finally, I get something interesting.
You guys should you guys should come to the family office sometime if you think that's awkward.
Oh, I'd love to be in the dinner table with the Sachse fam. I mean, I got so many questions about your childhood.
Yeah.
and teenage years.
As a follow-up to that, Ali's asking, you mentioned that 2x to 5x over 10 years isn't that exciting for your family. What sort of returns are you hoping for, expecting from your family VC investing?
So that I was referring to the direct there, Ali. As far as the fund investing, yeah, I mean, we're indexing for at least 2x on any fund that we do. But the directs is more the 10x of what I talk about. But yeah, I'm not saying that across the board for VC funds, but everything we do and every pro rata decision we make, I try to look at it is, can it 10x from here? And the reason I do that is because my family is investing in all these other asset classes that they know a lot better, they're more comfortable with. So the risk reward profile doesn't make a ton of sense for me to do that, especially if stuff doesn't go well. So that's why, I index for 10x return on directs and ideally 2 to 3 plus on funds.
I got a comment on that too, Lydia, if I can add on, which is one of the strategies that we had at Hustle Fund in terms of how we try to sell our value to our own LPs is actually on this notion that we can be a lead gen for directs. So if you, there's a weird kind of, let's call it norm that I've seen in venture where there's these GPs that want to be like this walled garden between their LPs and the founders. And I don't know where that came up.
I see a lot of them. Yeah. I know
yeah, a
that.
lot of them are like that, right? It's just like, oh, no, don't talk to them. Like, just
it's
give us
job
some money.
preservation strategy. It's because they don't offer much more than capital. But yeah.
Yes. And I think actually fund size really matters here too. So like if you're like struggling to put in your check, then there's not going to be enough allocation to bring in anyone else. Generally, you're kind of like fighting to take all the position. But if you're a fund that's relatively small, let's say less than $50 million of assets under management for a given fund, then you can actually play off the thing that we try to sell too, which is, look, here are the companies that we invested in. If you want to talk to any of the founders and you want to broker a deal, it's great. Here are the terms that we did on and so forth, or even try to fight for some additional allocation. We do this with Angel Squad, for example, one of our communities. It works really great, but it does break once your fund becomes a little bit big, like over like $100 million. I'm not sure if that works very well, but for a lot of the emerging GPs, I think are on this chat, consider that too, because the return profile on going direct should be higher than actually what your fund will produce as an ROI over time. So if you have a sense that, you're talking to an LP that wants to do a little bit of direct or a lot of direct, then I think that's a part of the story that I should at least consider, is understanding how you can systemically bring up these opportunities for your LPs to go direct as well. And Dave definitely is quite active in this.
Yeah, and actually, if I can piggyback off of that, I think this will help a lot of the GPs that are on the call. So you probably hear from a lot of family offices, hey, cute fund, really like what you're doing, but we only want to do direct. So why don't you just send us your best direct deals and we're not going to invest in your fund? That's super annoying. That it probably comes up a ton. What I would then in turn turn around and say to a lot of the family offices that I talk to, again, that's why I preach you should work with people doing it full time. But if you really want to entice them, if you're an early stage fund that's pre-seed through Series A, most of these family offices, they say pre-seed and seed. They don't actually want to do those deals when they see the data and the traction. They're really more probably Series A and Series B. And a great opportunity, if you're an early stage fund and you don't have an opportunity fund or anything like that, filling out pro rata and being able to articulate, hey, family office prospect as an LP, you could participate in some of our later stage deals and you could cherry pick the ones that come out from our crop. Because we're going to have pro rata in these and we're not going to be able to fill them all.
Yeah.
We want LPs like you to come in and help that out. And not only will that be an open, transparent relationship, but then you can also have your desire of direct vetted deals in your portfolio. So I would take that approach if I was a lot of early stage GPs, because the thing that shocks me the most in chatting with a lot of early stage GPs is that they often don't articulate their thoughts on what they think of a startup. So those that do and put that out there and say, this is why we're investing, not because Sequoia's Scout Fund is in, but because ABC on the founder and other stuff, that is what all of a sudden will make family offices get excited and be like, I want to work with that individual and invest with them.
Okay, this is worth expounding on because I think the GPs are kind of chatting about this right now. I've been picking on Dave all night, so I'm going to make fun of Lydia now. So let's pretend Lydia's a family office manager. And then she's like, yo, I'm investing in Hustle Fund. I'm like, yes. And then she's like, but I want to see some direct deals. Okay. So give me your Paretta. I'm like, okay. And then I find founder Dave, and Dave's like very happy to take our first and second check out of Hustle Fund. And they're like, yo, Dave, we don't have any money left, but we want to put like $1 million. Right? And to do that, we're going to have Lydia put it in there. A lot of times founder Dave's like, who the hell's Lydia? Right. So like be prepared to fight a little bit, or at least set an expectation with their founders about like selling why it makes sense and it's exciting to have Lydia's capital, your family office's capital to participate and take this Paretta, because it is sometimes an area of pushback. I have a hack though on how you could potentially get around this. It's like, I'll be like, Lydia, bad news, right? Dave's like, who the hell are you? We can't get you in. But here's the plan. Let's create a special purpose vehicle. I will contribute a very, very tiny bit of capital. It's not very much because I don't have very much on reserve. And then you put in the majority of it, but we'll call it Hustle Fund Lydia or something like that, this SPV, and then see whether Dave can consume that. And in general, I think it's an easier kind of piece of medicine to swallow, because like it is still like under like your fund's brand. It is a special purpose vehicle, which are easy to spin up on Angel List. But I want to sort of call out that dynamic, because a lot of family offices are not like Dave, who are like actively trying to add value, not be just a capital commodity. Most family offices are kind of just capital commodity, if I'm going to be honest with you. So like, just because you can say you're going to offer the Paretta, in execution, it can be very difficult to do, but the SPV hack might work. So I wanted to call that out. Lydia, I know there's more questions, but I don't know if we have time for one or two more. No?
We'll do a quick one. We'll do a quick one because
Okay.
I do want to answer to Prantha, who asked, would you invest in accelerator/studio funds? How do you think family offices react to this extension of the asset class?
Oh boy. Yeah, so I have invested in accelerators before. Generator is one of the local ones that I support out of Wisconsin. They're doing some great stuff on a national basis with their free program G Beta. You should definitely check that out. But as far as studios, it's usually, I have not seen a studio model that I ultimately get overly excited about, because I do a lot of analyzing the people and the why behind it. A lot of studios I see are just pairing smart people with problems that eventually they give up, because when it gets hard, and startups are really, really hard, they don't want to keep going because they're not that intrigued about the problem. So there's not a lot of studios that I've even seriously considered, because I just think that is a huge crux, but it's also an area that I haven't, dove too deep. So I could be, pretty naive with what's happening in the studio space now.
Very
Gotcha.
cool.
Perfect. Thank you. And
Lydia,
I think, I'm sorry, guys, if we didn't get to your questions. Stick around. Maybe the same questions can apply to our next speaker. But as far as this conversation goes, Eric, I'll let you close it out. Dave, thank you so much. And
Thank you.
Thank you for the plug for Camp Hustle Asia. I'm excited to see you there, and I'm excited to see other people there. Eric, all yours.
Dave, you're great to chat with per usual. Thank you so much for bringing the transparency and honesty and all the support you bring to family offices as well as to founders as well. For those of you who've been listening to our conversation, we've been speaking with Dave Sachse. He's a managing partner of Sachse Family Fund. You should check out their investment portfolio at saxefamilyfund.com. And also, he's also the founder and managing partner of Family VC. Check them out at familyvc.com. It's a unique community of venture investors serving family offices in particular. Dave, thank you so much for doing this with us and staying up late. And if you have anything else to close with, I'll leave the floor to you.
Yeah, I think the biggest thing that family offices don't realize that they're battling is adverse deal selection. Every investor is doing that, but family offices have it even worse than you can imagine. So if you can help them with that as a GP, it's going to definitely serve you well. But thank you so much, Hustle Fund team, Lydia, Eric, Sheehan. It was great seeing you all. I'm looking forward here to these next speakers as I will be listening in. So thank you so much.
Thank you, sir. Back to you, Lydia.
Thank you. Thanks both. All right, we're moving on. Things are heating up. And by the way, I already have some confirmation that, some of your questions will be answered by our next speaker. Please feel free to take a quick bio break. We're not going to leave room for that in our schedule, but, come right back. I do want to do another plug. If you're enjoying this, if you're feeling like, wow, I would love to see more quality people in my life and meet them in a very casual environment, then we are hosting Camp Hustle Asia in Bali in September. I'm going to put the link down. I'm going to put the promo code down and come join us. It's our third time doing this. It's been a blast every single time. And it's an amazing opportunity to meet potential LPs, GPs, other angels. So without further ado, I'm going to give the floor to Xian, our GP in Singapore, who's going to be talking to Ping Goh, the family office in Singapore. Xian, go ahead.
Awesome. Well, hello everyone from the other side of the Pacific. Super excited to chat with Ping here this morning. So Ping, it looks like you're in your car. So we're going from the garage where Eric was to the car. I see a theme here. Calvin, Hao, you guys are on next. I don't know where you're going to take us, maybe onto a boat. But maybe you could just introduce yourself and your family a little bit and talk a bit how you got into venture investing.
Yeah, sure. Hi, everyone. My name is Ping, and I'm in a company in Singapore called WeHer. So I currently run and helm one of the subsidiaries of WeHer, which is WeHer Capital. It's a fund management arm. But broadly speaking, we were a company founded in 1980 in the construction business. And then 30 years later, we got ourselves listed on the Singapore Exchange, and it went upstream to do property development in Singapore. In Australia, we own a couple of properties in workers' dormitory in Singapore and purpose-built student accommodation in Australia. And that's kind of what happened in the past 10 years of my life, doing real estate. So a lot of people then ask me about, how does a real estate guy get into the venture business, right? And this is I always love sharing with kind of my friends and my network around me. So back in 2017, I had some chats with my dad and my uncles, who is at the board of directors, and I told them that, look, we really need to diversify away from real estate. Just because real estate as an allocation amongst everyone else's portfolio is a huge allocation. But still, we need to diversify and really just get to know the people in venture. So I would say on the onset, it was really not about the returns, the financial returns. It was really about just getting in touch with another part of the world doing venture, right? Without doing venture, I wouldn't have known all these wonderful people. So we started getting into venture investing in 2017, 2018. We invested in quite a few Asian focused VC funds, and as well as doing a couple of direct investments. So that has panned out. We have mixed emotions about that. And Shri, do you mind if I just share kind of our observations after that?
Please, yeah, please do.
Yeah. So we had a pretty sizable budget allocation, double digit millions USD. So we invested majority in VC funds, and then we also did a couple of direct investments. So my appreciation after 5 years of investments is that, number one, we kind of just stopped doing direct investments, because our setup, we are just not built to be able to support the entire venture ecosystem. Well, we do have a little bit of capital, but we don't have the network, like Shiyan and Eric, they have built up over many, many years of experience. We are not able to open a lot of doors. We can't connect them to kind of the Series A investors and stuff. So when we did our direct investments, we always feel like, we are unable to help the startup and our portfolio companies. And we always try our best to do so, but we are limited in terms of our capabilities and our network. So, but we still like venture capital as an asset class, because I think research has shown past 15, 20 years, especially in the US, venture capital investment as an asset class still stands out strongly against the other asset classes like the public markets or the private markets, private equity and real estate. So, and that's why we wanted to continue to stay invested in the ecosystem. But the way we do it is just through fund managers. So we are now doubling down on our investment into venture capital funds, and our focus area is actually in the US.
Awesome. And I think maybe you can share a little bit, like, what is your setup, right? Because I think it's probably pretty typical of a lot of family offices who think they want to go direct, and then maybe you can share sort of like how you realize, like, hey, actually, we don't really have the resources to run like a full-blown directs effort?
Yeah, so I think number one, if you want to do direct investments, it's like there are so many verticals and so many sectors. I was just speaking with another fund manager, and they said, oh, they run analysis on 52 verticals. So like, I mean, I can't think of any family office that I know of that has actually the team and the army to really run this kind of analysis, to really then pick the sectors that you want to be in. More often than not, it's kind of like hearsay, right? Oh, you know, this AI sector is looking good, healthcare sector is looking good, quantum is looking good, and then you kind of just start to do research on that, and that I think it starts to get a bit myopic in nature. And then secondly is, you know, if you are trying to get into a direct deal, you know, do you think about leading the investment, you know, setting the terms, and you got no experience in doing that? And then if you are not leading the investment, and then you're just following on, you know, there may be a lead investor that is leading the investment, but you kind of then don't have any control over the investment because you are a very small shareholder. And more often than not, you know, if you're doing this, you know, as an initial allocation, you're not going to put big checks behind it. So I mean, it's always a prioritization. You know, the founders will lean towards those who have a bigger check sizes, and then you know, you often get left out. You don't get a lot of information rights. So then it kind of doesn't feel meaningful, right? So you know, I would much rather be a LP in a fund that can commit meaningful check sizes to the portfolio companies, or if they are not big check sizes, you know, they are on the cap table because the founder finds that the GPs of the fund is very useful at opening up a lot of doors. So I think with that, then you can kind of get aggregated information from the different GPs that we invest in, and then you start to get a view and a perspective for the venture world.
So, you know, just to take you back earlier to how you got into it, you know, you told your dad and your uncles like, hey, I think we should diversify. And, you know, there was a question in the Q&A earlier, which was like, you know, why would anybody pick venture? Like, shouldn't you get better returns out of real estate? And for you guys, you started in real estate, so you wanted to diversify out. But I guess maybe talk more broadly about, you know, how did you think about your allocation to venture? Why was it kind of the first place that you were like, hey, I want to learn more about this? And maybe how to think about it in your asset allocation, because, you know, there's a lot of new family offices that are being formed. They often have a large real estate component, or kind of an original business where they built their wealth, and they're starting to think about allocations. And so, you know, maybe walk us through your framework for how you think about portfolio diversification.
Yep. That's a very good question. And maybe I just share a little bit about how different real estate is from venture capital. I think, you know, and let me share some tidbits in terms of when we first started venture investing and we were looking at some direct investments. You know, when the team looks through the deck and it looks through the data room, the first thing we look at is the financial modeling. And you know, you're looking at financial modeling for a startup, early stage. So, you know, and we go in and we try to play around with the Excel and try to do sensitivity analysis, which, you know, at this stage, you know, I'm quite clear that that is just not the way to do it. You know, we try to apply, or what if, you know, plus 5%, plus 10%, minus 5, minus 10%. And that was a disaster, right? Because I mean, in early stage, you know, some of the metrics can be, it's kind of like binary, it's either one or zero. So that was a very interesting experience. So that's kind of how different it is. And that's kind of why we are steering away from direct investments. In terms of allocation to venture capital funds, this is how we are thinking about it. So I convinced my family to look at venture in terms of a long-term recurring income, right? So because we know that investing into any venture capital funds, you kind of expect your returns 10 to 12 years time frame. So I convinced them to say, okay, give me a consistent allocation to venture capital funds. Call it 3 to 5 million every year. So I got them to approve a 10-year investment horizon, where we will invest anywhere from 30 to 40 million USD. And from the 11th year onwards, then we will start to get, you know, hopefully start to get DPI, from our earlier investments in the year 1, year 2, and year 3. And after that, I basically told them this will be part of the recurring income for the group. Of course, from a risk allocation point of view, venture is still higher risk than real estate for sure. And therefore we size our allocation accordingly, as a percentage of kind of the total equity of the group. This is a smaller allocation compared to what we are doing for real estate, definitely. And also the other way that we are mitigating the risk is really just to kind of do it as a fund of funds strategy. So I have actually partnered up with another friend of mine, Shihao, to create a fund of funds product. So we are pooling capital together between ourselves, being the largest anchor investor of the fund of funds strategy, and also friends and families in the network, to allow us to, number one, be able to kind of just de-risk, build a proper team around it to really look through, all the variety of early stage funds that we see in the US, as well to put meaningful about 5 to 8% stake into all these 15 to 20 early stage funds that we are looking to invest in over the next 2 to 3 years.
So, I mean, that's a big doubling down, right? You said, hey guys, we're
Mhm.
diversifying, we're going to funds, and now you're like, we're committed to this strategy, we're going to raise a fund of funds. But you said you're going to focus on the US, whereas your earlier fund investments were Asia focused. So
Correct.
talk a little bit about how you made the decision to focus on the US, first of all, and second of all, like, as you're talking to other families about allocating to the asset class, how are you helping them understand why it makes sense for them when they could have been making their money in palm oil, stainless steel, other types of things that are, pretty far away from some of the things that VCs are investing in?
I mean, personally, because number one, we are already quite heavily invested in the Asian VC fund. So it makes sense for us to diversify away from a geography point of view. I mean, the whole anchor theme for this is really about diversification, right? So we are diversifying across vintages, we are diversifying across sectors, and now we're also diversifying across the geographies. And then US seems to be a very logical next step for us, just because, I mean, the few markets which are big in early stage, US is definitely one of them. And Shihao, he has a big his family as well, great connections to the entire US venture industry. And I think for fund of funds strategy, really in terms of identifying the right funds, there's a whole science behind it. But just how do you actually get, I mean, that there are no listings in the world. They kind of just say, oh, these are the 1,000 early stage funds, right? Because a lot of them, don't follow a particular sequence of appearing in front of everyone. So it really depends on a lot of referrals, from either, the GPs that we have invested in. It also comes from hot leads from other LPs that we have gotten to know over the past few years, because we have either invested in the same fund, or it's a friend of an LP that we are invested in, or the founder on his cap table, or he sees that this is another person that is the same strategy as us, and then they make a warm referral. So all these things are very important in a fund of funds strategy.
Can you share, as you were learning about the asset class and starting to meet people, things that you found strange or counterintuitive? So you shared a little bit the story about like trying to do sensitivity analysis on early stage models that were probably, largely works of fiction. But, what have you kind of learned along the journey about evaluating fund managers that might not be immediately apparent to a family that's just starting the journey?
Evaluation about the fund manager that is not apparent. Or maybe if I kind of just twist the question and kind of say, what are the things that we actually look out for that might not be apparent in the first time. So I think number one, when you're investing in kind of early stage fund managers, and our strategy also to invest in fund sizes which are small meaning below 100 million in fund size. So these tends to be fund managers or GPs who have just started, their first fund, but they have come from a very distinguished background, or they are doing the fund 2 or fund 3, right? So we usually try to take our time to actually build a personal relationship with them. In the very first call that I do with all the GPs, I always end off the call by asking them, so what do they do outside of work? Some of them like to do hiking, some of them do F45, some of them do fishing. There was one that likes to make red wine, he orders his own grapes and crushes them, right? So it's just kind of very interesting to kind of start to go a bit deeper and building up the personal relationship. Myself and Shihao, we are in the Bay Area, or sometimes in the East Coast, every 2 to 3 months. And then, we try not to have very formal meetings settings, and we try to just hang out with them, even hang out with their families, because I think ultimately we want to get a very good judge of character. So then we try not to rush into the due diligence as well. So that it probably takes us at least 3 to 4 months before we actually make a decision whether we want to invest in the fund or not. So I think that's kind of one main thing, which is kind of just to understand the character and the person a bit more. And in funds that have more than one GP, so other than solo GP, sometimes they have a team of 2 to 4 GPs. It's also equally important for us to understand the team dynamics. So we will go out for lunch or dinner together, and then we will just observe how they interact with one another. Your team, Shi, and you guys are the kind of the perfect example of how a very well-gelled team, very cohesive, works together, and that makes a ton of difference, between someone like a hustle team and someone and another team that has 2 to 4 GPs, but you will find that in the lunch or dinner setting, they are like, maybe they just got together not too long ago, coming from very different backgrounds, are quite polite to one another. That kind of gives us the signal that, okay, maybe they are not there yet in terms of team dynamics. So I think that's from a relationship point of view. The other thing that we start to see a lot is, and this is something that we're always looking at, is how are they differentiated from the rest in terms of access? Because almost everyone in the deck will tell you that, oh, they have access to a university research team, and they are always plugged into the Y Combinator and stuff. But that is like just very superficial. So we tend to ask a lot more questions about how unique they are in terms of accessing, the deal flow. That why would startups go to them first before going to other people? And interestingly, actually, we have seen a lot of startups that have tried to, and that can show the differentiation from an access point of view. We have some celebrity funds. I won't name them, but that is actually also a good way of accessing. The other good way of showing access is actually the communities that they have built up. Like Hustle Fund, it's a great community. And there are also some other funds that build a great communities. We met another fund. All the LPs are ex-entrepreneurs that and founders that they have backed previously. So it's a very entrepreneur driven LP network that is just self-fulfilling and in a very positive virtuous cycle, helping the next founders as well. So this is the second thing that like when you read decks, don't just buy into the, oh, we have great access and network. So I think this has to be drilled down a little bit more. So I would say these are kind of the two big things that we're on. Number one is on the people, and the other one is really on how they are getting the best deals.
Do you have any preference in terms of portfolio construction for the funds that you're invested in?
Okay, and this is a very difficult question to answer, because there are, at the early stage funds, there are so many different types of strategies. So do you go to a fund that buys into the concentrated 25 to 30 portfolio companies, and then they double down on the winners? Or do you go to a kind of like a spraying fund, like 200 portfolio companies, and then what does that mean for your portfolio construction? So So I think that's another conversation. But in terms of portfolio construction, we try to aim for about 15 to 20 VC funds. You know, we are raising a 50 million fund, maximum. So anywhere between 2.5 million to 5 million in terms of check sizing for each fund. That will give us 15 to 20 funds. I think underlying what we are trying to achieve from a diversification point of view is really to construct a portfolio of underlying 300 to 400 companies. You know, some research and you know, people have run Monte Carlo simulations that shows that seems to be reasonably a reasonably large number for you to achieve the diversification that you want, and still have a good possibility and probability of achieving the kind of 3 to 5x returns that we are looking for in venture investment.
Something that people often raise with managers is how much the GPs have put in as the GP commit. How much does this matter to you? Do you have benchmarks around what you want to see GPs commit to their funds? And, you know, does it vary between people who are earlier in their career, who may be less liquid, versus those who are later in their careers and have more access to capital?
Well, there are a ton of questions that we ask the potential GPs that we want to invest in. This is often one of those questions, but I wouldn't put kind of a big number behind it, or big priority behind it. I mean, case in point, right? When I was raising my real estate fund, we put in 60% of the capital, but that's because we are new, we have no track record. And then, you know, for the second fund, we're putting in 30%, and then for the third fund, we probably put 10 to 15%. So I kind of see it as, you know, if you have to put a lot of capital, and if a lot of the capital are families and friends, maybe sometimes that may be good, sometimes that may not be so good. So we try not to think too much about it, as long as there is a good meaningful amount, anywhere from kind of 2, 3, 4%, then I think we are fine. What we are actually also more interested in as well is to kind of understand who are the LPs behind them as well, and that is often one source of reference checks. So we do a lot of reference checks and reference calls. Sometimes we do it by two channels. Number one, we ask them to give us some names and numbers to call. And on the other hand, we'll go to their LinkedIn, Facebook, or just news, just to find out, you know, because of our network, we will definitely be able to find 2 or 3 people that we can call, you know, just to have call it a silent reference check. Yeah, but just going back to your question, Shi, that is kind of not a deal breaker for us, you know, although you probably at some points, if they have meaningful capital committing behind the GP.
You talk a little bit about reference checks, which is obviously a really important part of your diligence process. What do you focus on in a reference call?
Oh, that's a beautiful question. Reference checks are actually quite difficult to execute in terms of being able to really find out what you want to find out, because unless the person that you're calling has a very bad relationship, you know, with the GP, you probably won't get much out of it. But you can try to tell. There will be some subtle differences in terms of a response. I can give you a very simple example. You know, you can have a reference call, you know, and then the guy will say, you know, very great things about the guy. Say, oh, he's the best manager I've had over the past 10 years, you know, always showing up, great initiative, great teamwork, versus someone that you call and say, oh, yeah, he's punctual to work every day, you know, that kind of stuff. So both are positive things, but one is a lot more positive than the other. And I think that's kind of how you can start to see a bit of difference between the very good references and the average references. So I think that's one. And so I think that's for the group of people that have actually worked with the GPs that you want to invest in. Another group of reference checks are with the LPs. So it may be with existing LPs. So with existing LPs, I try to understand about team dynamics. So I'll ask who they interact with more and why. And do they see that the team dynamics is good, or is there's one particular GP who is overpowering the other? So these are the things we try to find out.
Got it. And I think we're going to open it up to questions more broadly soon, but I guess if you had any sort of like final thoughts on how you would encourage people to explore venture as an asset class, where would you direct them? What might you ask them to start doing to get to learn or meet folks?
I mean, without trying to impress people that trying to sell a fund of funds strategy, but I really do think that fund of funds is a great way to start going into allocation for venture, because you kind of sit right at the top, right? You're LP of a fund of fund who is then an LP of the fund, so you get a lot of good overview into what the venture world is about. And my personal my personal mantra is for any investments is that if you really want to know about an investment, you just got to put some money behind it, because without putting money behind it, you'll never go through the ups and downs, and you will never
Got to
have a
feel the
real life.
pain.
Yeah, exactly, right. I rather enjoy the gain than to feel the pain. But yeah, sometimes it's a bit painful. And I mean, I've spent 5 years to reach a very simple conclusion that, well, if you are looking at it purely from a financial investment point of view, really just do it through funds. I mean, I acknowledge very quickly that there are so many people out there. They are just much smarter than myself, and so I feel very comfortable leaving money with them. I mean, you put a 1 million and you pay a 1% per annum fee of 2%, right? That's like 10,000, 20,000 a year. That's not even enough for you to build half a team, right? To really go through all the difficult tasks of grinding through, all the different startups out there, trying to find the right strategy, and gunning for all the exits. So that's a very tough job. So really leave it to the really much smarter people out there.
I don't know if we're much smarter, but we do spend a lot of our time focused on it. I'm going to start taking questions out of the Q&A that I'm seeing here. One is, outside of real estate and venture, what other asset classes would you consider critical for a family office?
Oh, critical. I think for family office, it's I must say there's no standard answer. It's like I have spoken to another family office here who is doing kind of directly opposite to what I'm doing, and they are very like for me, we have real estate operating businesses. I'm trying to diversify away and doing passive investments, right? Leaving the money with the smarter people. But I've got other family offices who are kind of going out to buy operating businesses, right? So it's just really very dependent on what are the objectives of the family, how much influence does the previous generation have over the current generation. I must say that at my generation, I was very fortunate that my family and my entire extended family have given the second generation much autonomy to kind of decide what is the direction for the second generation. But I can't really say so for all the other family offices and family businesses out there. Like personally, we don't touch we don't touch public equities. Yeah, just because no one in the family has any expertise, and obviously the past few years have been a bit volatile. So that just raised the psychological barrier of entry for us. And I think it's also a function of how big your family office is. There are small size, there's mid size, there's big. If you kind of go all the way to the top, institutional capital, all the sovereign wealth funds, pension funds, why they have allocation to everything, right? It's just purely a reflection of their scale. They just have to allocate to everything, because if not, they might end up being overweight in one particular sector. So I think, at least for myself, when we look at our size, well, if we exclude the public equities, can we still have a meaningful allocation to the rest? And the answer is yes. So then let's not touch public equities.
Got it. And you talked a little bit about family dynamics, which is obviously unique to every family. How do you think about sort of communicating your investment work back to the family? Since you're the one who has the most exposure to it and they might not be as familiar, how do you kind of keep stakeholders on board and informed over what is a pretty long investment period, right?
Mm, mm, mm. So I think number one, one of the key difference is that I started off in the corporate business first, right? So, and then we are doing real estate investment work, right? So I have a team behind me, and everyone is kind of well versed in what they are supposed to do, and then the internal processes of doing due diligence and doing investment papers, socializing the investment to the board before it gets presented to the board. All these processes are kind of well oiled and well rehearsed internally. So, despite us going into a different type of investment, we are kind of still applying the same principles and discipline behind doing any investment that I mean, we also do other types of investments like sustainability, right? This is like entirely new for the group. But I think as long as you can demonstrate that, number one, I'm not the only one making the call, right? And when I write my investment paper, I make sure, or we meaning myself and the team, we make sure that the board is very aware of the effort, and the due diligence that we have gone through. At certain times, if we need, we will bring external advisors and consultants, and that kind of adds more weight to the due diligence process. And at the end of the day, we also remember to just size the investments accordingly. Don't be too gung ho about it.
You mentioned sustainability. How important is ESG or DEI as a consideration for funds that you invest in? Or do you think about sustainability as a totally different bucket?
Yeah. So for this venture capital allocation, not so much in terms of looking at ESG metrics that our GPs adhere to. So that's a different consideration. I mean, to be fair, when you look at early stage investments, everyone is trying to kind of test out product market fit, growing revenue, growing a team. I think unfortunately, ESG sometimes or most of the time might be at the back of their mind. Unless it's an ESG focus like a climate tech fund, then it's a different story. Then that we will do a lot more due diligence on. But we try not to have too many boxes to tick. If not, we might not end up deploying any capital at all.
Makes sense. And how do you think about allocations within the fund of fund between generalist versus specialist VCs?
Ooh, tough question. I think again, whether you are a generalist or you're a specialist, it goes. I think to me, our principles is, are these the right people to execute the generalist strategy or the specialist strategy, right? If you are a generalist strategy, and you're a solo GP, I will be a bit concerned, right? Unless you're a solo GP that has like 40 advisors behind you, right? But if you're a generalist fund, I will be expecting you have at least 3 to 4 GPs, and each one of them would have very different experience, whether is it fintech, whether is it SaaS, one might be a deep tech specialist. And then I will also expect the fund to have quite a few advisors that will complement the area of strategy behind it. But then if you're a specialist, then it's kind of easier to kind of understand where your expertise lies. You've got PhD in this or what. So we haven't, I mean, in our strategy, in our framework, we don't kind of decide how many generalist funds, how many specialist funds. It's really about understanding whether the people behind it are the right people to execute the kind of strategy.
On a related note, how do you think about the seniority of the GP you're investing in? Do you need gray hair? How open are you to investing in younger managers?
So for a fund of funds, the manager selection is of paramount importance. And let's look at the simple fund, with two GPs. One comes from entrepreneurship background, is a great operator on the ground, and the other one, has worked in an institutional VC fund. They like each other, they have worked and invested and they come together and decide to raise a fund. So I think by that, you will expect each of them to have at least, call it, 7 years of experience in their respective field. So with that, then they don't become like too young anymore, unless you say 35 to 40 years old is still young. But that I mean, if they have come out and worked since what, 21 years old, then they would have accumulated a lot of experience. So I think it's really not about the age, but it's more about where have they actually been working at before they actually started a new venture with these funds. Of course, if you're talking about deep tech, it's a kind of a different pedigree. We would see a lot more gray hairs, and that is a fact. Because a lot of them are professors, are PhD, and they somehow got convinced. Like, we were looking at this fund, the early investors in the Zoom, all PhD, all from, if you guys know Tsinghua Daxue, the prestigious university, but they have spent half of their life in the US. So we have that kind of pedigree as well. I wouldn't say, it's I wouldn't say either or is good or bad. Again, it kind of plays to what kind of strategy. So if you're a deep tech fund and you are like 30 years old or 35, right, I will also be a bit concerned.
Got it. Great.
Hmm.
How do you think about so the technical expertise of a PhD in evaluating technology and the bridge to, can it be commercialized? Do you think about that what's the sort of GP team you'd want to see for a deep tech fund?
I'm just going through in my mind the deep tech funds that we have seen and that we have liked. I think number one, in terms of the experience the GPs have, I think definitely you want them to be at least of the 10-15 years of experience. You want them to be very deeply connected to the network. Like, there's this particular fund that we looked at. The GP did a lot of consulting work for Epic, which is huge healthcare database provider, and has 80% of the market share, and then knows a lot of, and it was doing distribution for them, so knows a lot of CTOs and of a lot of healthcare companies. So you expect that kind. So we'll investigate a lot more into their network, and also typically for deep tech funds, you'll find that there are also a lot of advisors behind them. Because deep tech actually covers a wide range of sectors, of subsectors as well. So it's impossible for one, like you'll have one GP which is very good in photonics, yeah, but that's just like really one subsector, and then you have someone who's good in material science. And I think I would also prefer if the GP has experience in M&A, in doing previously at a corporate role, or as an entrepreneur, build up a company, bought and sold companies, because that is, and I think at the end of the day, all of us want DPI, and deep tech companies, with a longer gestation period, that the exit becomes, even more important. And you'll find that a lot of all these deep tech companies, usually they will exit via M&A, like strategic acquisition, from some of the larger companies in the world. Yeah, so a mix of all these experiences would be very crucial to the manager selection process.
How do you get comfortable investing in funds where you don't have expertise?
And that's kind of the beauty of doing fund of funds, right? Like, your skill set is really on judgment of whether that team or the GP can actually execute the strategy. I mean, just now I touched on building the personal relationships and stuff, but there's also a whole scientific process where you go through looking at the past track record, You know, and a lot of them are just based on comparison as well. For example, we'll line up 10 funds with track record in the 2013 or 2014 vintage years, right? And then you start to see one or two funds having great DPIs, as you would expect from a 2013, 2014 vintage fund. It's been 10 years, right? They must have had some DPIs. But there are some funds that we saw, you know, they are showing huge TVPI, but almost close to zero DPI. And that is a red flag for us, because it kind of tells us that, you know, either the sector that they have invested in is just very difficult to exit, or they are not thinking about exit a lot of the times, which is a concern for us. Yeah.
So for managers who want to approach family offices and funds like yourselves, what's the best way for them to approach, right? Given that, as you mentioned, it takes time to build a relationship, to get to know each other. You know, how would you advise new managers to reach out to families?
Okay. And I think, to me, this is more of a universal truth, right? I think as long as you're fundraising, I mean, I've personally done fundraising as well. It's kind of hard to qualify. I mean, for venture capital, maybe yes, you can qualify. Whether the family office is actually looking into investment into venture capital, so you can kind of do that first funnel, right? Those that say no, it's just too difficult to convince, right? So you can put them to one side. But for those who say yes, I think the universal truth or rule is just to reach out to as many as possible, right? You just got to hustle. You have no choice. You just got to keep making new connections, keep meeting new people. Don't forget to enjoy yourself in the process. You know, just, you know, making new connections. A lot of them, or some of them might become your good friends in the future. Until you get what you want. Yeah, so I think that would be what I would say. Like, I don't think there's a hard and fast rule to say, okay, you know, you need to target certain size or certain geographies. You just got to, yeah, you just can't be lazy, and just got to reach out to as many people as you can.
So I think historically families have tried to stay under the radar, right? They don't want to be pitched almost. Do you have any advice for folks who are trying to build those relationships and network into folks who are more receptive to some of these pitches?
Yeah, yet I think that is changing, actually, right? Because I think the family offices of the past we're talking about, I mean, especially those in Asia, was set up by the patriarchs. I think Asia, as a kind of the eastern part of the world, is going through a transition, a generational change. You know, passing the baton from first to second to third generation. And you know, when I speak to peers kind of around my age, whether second or third generation, everyone is a lot more open to listening to ideas. You know, whether they are from huge families or they are from smaller families. You know, everyone is just generally a lot more interested to share and also to listen. So you know, I don't think there is going to be a differentiated strategy. And and when I reach out to new family officers, you know, and I speak to them about this strategy, you know, I send them the deck. I always just tell them, if you know of any other friends or family officers that are also interested or might be interested, just feel free to send the deck to them. Right. So this, I always end up with this, you know, so that there is a possibility that, oh, it gets passed on to another person, and then it just gets passed on and passed on and passed on, and then that will get you the critical mass that you need.
Got it. A few sort of questions here. I think we can take these pretty quickly. Given such long investment horizons in real estate and venture, how do you think about managing liquidity?
So advanced planning is important. Advanced planning and contingency. So you got to kind of just think about kind of first principles. Number one, how much money you have, how much money how much working capital do you need on an annual basis, and how much income you are receiving from other sources of businesses, then you can just really chart out the cash flow analysis to determine kind of what is available free cash flow for you to invest over the next 5 years, at least quite realistically. But the other thing I would say about venture investing is that, and especially early stage, is that now number one, early stage funds usually have allocation to first checks and then follow on, right? So you often have, it's quite often to hear this fund saying that, oh, 60% of the committed capital will be reserved for the first checks, and then 40% will be for follow on. These are for kind of, call it, concentrated portfolio strategies. So, and then the investment period is typically either 3 or 4 years. So let's say you invest in a particular fund. For the first 4 years, they will draw down 60% of the committed capital. And then they'll take anywhere between the next 2 to 3 years to finish doing the follow-on. So for a typical fund, you're expected to draw down the full capital only maybe about 6 to 7 years. And then you start to map this up into the fund of funds, right? Our investment period is 3 years, right? So in the third year, we may be then investing kind of in the last fund, which will then take another 5 to 7 years to deploy. So actually, the entire drawdown for the fund of funds strategy can be anywhere from 6 to 8 years. So it's pretty long, and I think it's pretty manageable. If you're putting 1 million into the fund, I wouldn't expect to draw more than 20% in any given year, right? So that's quite easy to manage. And I mean, that's also how I convince my uncles. Yeah, they are all like old and 70 years old. And then I always tell them, you know how Pate Philip always has the advertisement, you're buying for the next generation. Yeah, so this is the same. Right? You're investing in this, and then, so that my cousins can reap the rewards.
So that's an interesting point, right? Which is, how do you think about, succession planning and legacy for the next generation? How do you think about educating your kids about, the various asset classes, and do you hope that they join the family business, whether it's on the construction side or the investing side, or do you think this is sort of something that you would generally want to hire more professionals for in the future?
Give me 5 seconds. Okay, so I think for my kids or for the next generation, it's not something that I can answer now because, to be honest, I haven't thought about it yet. Right? I think the first premise is you just want them to grow up, being good citizens and contributing to society, right? So have not even reached the financials and everything. So I think my kids are still young, 2 and 4, and another one coming soon. So that's maybe and maybe if 10 years down the road you guys are still doing this, I can answer again. So that's one. But I think my point of reference will be how the first generation of the Weher family has shown, has given us the autonomy, has given us kind of the runway and the platform to do what we want. Of course, in a very controlled and in a very prudent way. So I think a lot of what I do for the next generation from a family business point of view, a lot of it will bear resemblance to what the first generation did for us, giving us sufficient call it corridor length or width, for us to play around, but always kind of just controlling from an allocation point of view. And I think that has worked pretty well, at least for the second generation. For the third generation, it is yet to come.
Understood. I also have small kids, so it's hard to imagine that far in the future sometimes.
Yeah, definitely.
We're going to do 2 more questions, and then I think we'll give people a bio break, and then we'll invite the next panelist up.
Okay.
So last 2 questions. How much does fund size factor into your decisions, especially for first or second time fund managers? And I think you mentioned you like to invest in funds that are sub $100 million. And does fund size vary? Does this fund size consideration vary depending on whether it's a fund of funds versus a single family office?
Okay, so from a fund of funds point of view, so we are not raising a large fund of funds. We're only raising 50 million, and that's why we have a hard cap of 5 million, right? So into any funds that we invest in, so kind of call it not more than 10%, and that is really just from a risk mitigation point of view, and that's why we, when it gets to the 100 million or even 150 million mark, we kind of try not to do as much, because then you become, from an ownership point of view, you become smaller and smaller in those funds, and then at some point in time it is not meaningful anymore, right? So I think this is number one. But I think fundamentally we like small funds, not because of the ownership stake, but more because of alignment and motivation of the GP managing a small fund, right? I mean, a small fund, let's say 50 million, let's say the average fees are, over the period of 12 years or 10 years is like 1.5%. 50 million fund, that's like 750K every year. They might have a team of 6 to 8 people, and that's not cheap, right? I recently knew that US salaries are a lot higher. So 750K, you can barely, you can feed everyone. So that their motivation is going to be on the exit, because the carry interest is what will make them a little bit richer, a little bit happier, and then will ensure longevity in the business. Compared to a Tiger Global, right? I don't know how much funds they raise, maybe 10 billion, right? And the fees, even at 1% per annum, is like 10 million a year, and over a course of 10 years is 100 million. I mean, for sure, that is enough to feed an entire army with a little bit more to spare. And then that kind of makes you wonder whether, just purely from a theoretical alignment discussion, whether they are or motivation, are they actually motivated to go for exits? So that is, and we have done sufficient research to tell us that small fund sizes, tend to outperform larger fund sizes, and that's it. So and then the other related discussion is that the stage that we are interested to invest in is early stage, right? And early stage means smaller valuations, smaller check sizes. If you are raising a 250 million fund, you can hardly call yourself an early stage fund, because how do you deploy 250 million into early stage? It's just too difficult, right? So and we have met fund managers that tell us that forever they will be at 50 million or 75 million, because that's a space that they are very good at, and that's the space that they want to be.
Awesome. And then last question, do you feel with the increased openness of Singaporean family offices, their risk appetite has similarly increased?
Okay, so we are talking about risk. So I think the kind of common misconception is that, okay, not a common misconception, but people call venture capital a very risky asset class. Some people liken it to gambling. In Chinese we call it 风险投资, which is risk investment, risky investment. And I can extend that to real estate, right? Some people who have never invested in real estate, never been in the business before, can say real estate is risky. Yes, it's right? Because they see it from an outsider point of view. But the people who know it a lot knows how to mitigate those risks, or they have expertise to manage those risks. So I think it's the same for venture investing. So I think rather than saying that the risk appetite has increased, I think it's just general, the flow of information and exchange, all the venture capital events here and the one that you're holding now. I think it's a good way to kind of just level up the understanding of the venture capital asset class, and just really understanding that, well, is it really that risky after all? It's risky if you have 500,000 to deploy and you put it into one fund. That is risky, right? But if you have 500,000 and you put it into our fund of funds, you get exposure to 300 to 400 companies. That is risk mitigation. That is not risky from my point of view. So I think it's more of that rather than saying that the risk appetite has increased.
Thank you. And if people want to reach out to you, if they want to be LPs in your fund, or they
Yep.
want to pitch you, what's the best
Yep.
way to reach you?
Well, can email me at Ping, my full name, at nextgen.vc, nxtgen.vc. So it's the next generation, next gen without the E.
Awesome. I will drop it into the chat, and
Yep.
then we will hand the baton off to Hao and Calvin. And thank you so much, Wee Ping, for joining us.
Thanks a
Really
lot.
appreciate your insights, and
Thank you
for your candor.
Okay, thanks a lot, Sheehan, for inviting me. Thank you. Thanks, everyone.
Thank you, Wee Ping. My gosh, I feel like we just like took all of your knowledge and collectively downloaded it into our brains. That was beautiful. What a deep dive. Thank you so much, Wee Ping. That was amazing. Bye. All right, everybody. This is great. We still have about 100 of you here. I know many of you are going to be watching the recording. I want to just say thank you for all your wonderful questions to Wee Ping. Sheehan was reading them off for the last, 45 minutes at the very least. So questions just kept on coming in. It was lovely. If you're thinking, hey, Lydia, this is amazing. I would love to see all these people in person. Then come to Camp Hustle, because that's what we'll be doing in Bali, September 18th and 19th. It's not our first rodeo. We've done this before, and we always make them really fun, really casual, investors only, no founders pitching you, just LPs, GPs, angels, high net worth individuals. So come join us. I'll drop the promo code again. And without further ado, feel free to take a quick break and then come right back, because we have Calvin Lam here with us. And funny story about how we got Calvin on board. We were looking for a Vietnamese family office. We reached out to Wee Ping and asked him if he knew anybody, but we already knew we wanted to have Hao here to interview him. Reason being is because Hao is the CEO of Vietcetera, our portfolio company that we love and work with regularly. And then when I reached out to Hao and said, hey, we're going to get Calvin, he was like, oh, that's my investor. So who better to interview an investor than his own portfolio founder? I'm really excited about this. And they're actually in a studio because Vietcetera is just that professional. So Hao, without further ado, I'm going to hand it off to you. And I'm excited for this awesome conversation. Everybody, if you've got questions, put them in the Q&A and let's do this.
Awesome. Can you guys hear me? Good? Okay, excellent. Yeah, we've been, well, good morning from Ho Chi Minh City, everybody, or good afternoon, good evening, wherever you're calling from. I'm Hao, I'm the CEO and co-founder of Vietcetera. It's a media company based here in Ho Chi Minh City, where we're filming today. Calvin, like Lydia mentioned, is one of my first investors into Vietcetera. He's also a neighbor of our studio, so I thought just bring him on in, and I haven't seen him and talked to him actually in a couple months, so it's great to just have you here. Thank you so much, Calvin, for making time available.
So just for clarification, I had the luxury of just walk downstairs and cross the street and walk right into the Vietcetera office.
Yeah, awesome.
So we're lucky.
Cool.
Nice to meet you all, and I thank you to Dave. Thank you to Wee Ping. I learned a lot watching your segment, so thanks for sharing.
Awesome. Let's get into it. So as you guys know, I run a media company, but Calvin, who we want to learn from today, he runs his own independent family office. He makes a lot of different types of investments, not just tech companies, but also into real estate, into education, restaurants. He owns, he's one of the majority owners of one of the hottest cocktail bars in the city for a number of years now, and has a lot to share from that too, I'm sure, maybe for a different session. But Calvin, why don't we just start with an introduction about who you are and how you ended up in Vietnam? I know you're Vietnamese, but you went to the States and then came back. Maybe share that journey a little bit that motivated you.
Thanks, Dave. Thanks, Hao. Can I can make a small complaint about you first?
Oh, sure. Yeah.
Audience, is it okay? So I'm an investor in Vietcetera, and his office is downstairs from where in my apartment. But this is the first time I get an interview, and I learned today that you have made 200 interviews so far. So it's the first time I get to be here.
Yeah, 200 podcast interviews.
But anyway, so that's my complaint about Hao. But before we talk about investment, I want everybody to know that I'm not a very good investor, because When Hao talked to me round one, I didn't follow through. And when I eventually went in round two, I paid 2.5x compared to what he offered me before. So perhaps I'm not a very good investor. So anyway, a bit of personal grudge out of the way so we can get down to business. Hello, I'm Calvin Lam. I've been in Vietnam for 18 years. I relocated here from the USA. So quick introduction. My journey is I was born in Vietnam. I am tricultural in the sense I was born to a Chinese couple and born in Vietnam. And at the age of 13, I joined the wave of boat people and settled in America. From the age of 13 to 41, I studied in America, built my first business in America. And when I exit in 2005, I have a couple of options. And I chose the path least taken, the least travel. And I come to Vietnam for Act 2 of my entrepreneurial career. And it's been 18 years. Can you believe that? It's a long time.
Yeah, and for those of you that want to connect with Calvin and maybe learn from him after this webinar too, I call Calvin one of the OGs of what you would call like international people or overseas Vietnamese for that matter, coming back to Vietnam, in this case, the early 2000s, to work here, but also live here. I think working here is for sure one element, having the work environment, but living here too, it's a lifestyle thing for a lot of people here. Yeah. Why don't we get into the nuts and bolts a little bit, guys? And if you have questions, just drop them in the comments and we'll get to them after the Q&A section. A lot of people that come to me, businesses, people that want to work here, investors, they tell me that Vietnam, there's not a lot of content about it. They don't know people here. They go on the media. There's just not enough research to understand this place better. Why don't we kind of share about that? You mentioned offline that the Vietnamese market lacks a well-established structure of community. There's no communities like the one that we're on here today, or even service providers. Everyone from like the best lawyers to people doing due diligence to whoever it might be, which makes investments riskier and more challenging. Could you elaborate on those challenges? And despite that, what influenced you to continue making your investments, especially your own money? You've never worked for a fund.
Yeah, so this is a new economy. It's fairly new. So the infrastructure, the business community hasn't had the length of time, the longitude run for people to build specialization. So this is a country of generalists. Unfortunately, when it comes to mandate, when it comes to LP, there's a strong desire to lean on specialists. Specialists give us the peace of mind. Specialists give us a clear set of structure, give us a well-time proven formula. So this is a land where really you lack data. You like the long history of successes to build upon. So with a lot of respect for the folks who operate out of Singapore, out of USA, they have access to really good data, really good people. We don't know how to crunch it. We don't have any of those. We're basically an emerging market in an early stage. So we really have to write the rule book as we go. Yeah. And a lot of it is really quantitative metrics rather than qualitative. So one need to really innovate. And at the same time, we are trained in America. So there's a part of it that want to lean on facts. There's a part of it that want to lean on template and structure. So operating here, you need to be able to reconcile the two and still be able to survive, hopefully make a few dollars and go back and tell people how you did it.
I mean,
it's not easy.
Yeah, for the last 18 years, I mean, Calvin, you've done well. I think your investments, have largely ranged from good to smashing success. Do you see that? What are some headwinds that you expect, let's say in the next 5 or let's say even 18 years from now? For instance, I'm going to jump to one of our questions that I wrote down here about macroeconomic policies in the future. I think for those of you that are calling from overseas, you may have been reading the headlines. GDP in Vietnam is one of the highest in the world, 5% every quarter or whatever it is. And it's just astronomical. But at the same time, trade is slowing. The number of shipments and cargo shipments going from Vietnam to the world are decelerating quickly since consumer demand is falling, at least in the short term. And also policies like the government, there's been some changes at the government level. People don't really know what's going on. Bank bonds are frozen. Businesses can't get access. Maybe you can talk about that a little bit. What concerns do you have? And despite those, you'll push ahead.
Yeah, so this is a young economy with a relatively young government. When I say young government, in the sense that it is moving away from central planning to capitalism, you have to embrace it. The door is open to the capital market, largely open, but the government is writing a rule as it runs the country. On top of it, so you have a lot of learning taking place. On top of that, we have a relatively small economy. So any kind of growth, you have a tendency to any kind of growth tend to get multiply a lot. Any kind of slowdown, you feel the impact right away. So this is this is emerging market. So there's a lot of this up and down, up and down, up and down. Mind you, long-term, very robust growth. So you just have to have the stomach. You gotta have the stomach, and you got to have the flexibility to turn on the dime. So it's really it really taxes the person who is on the ground running things. So, but being the entrepreneur that I am, to me the risk-reward ratio greatly favors the risk taker.
Awesome. Yeah, I mean, we were talking offline earlier. So Calvin, you run a family office, obviously very diversified, including tech investments that you've made personally, such as in Viet Cetera. It's under your name, not a VC fund. But with that said, you've also been an LP in funds as well. Maybe you can talk about the experiences you've had between the two and what were the benefits. You mentioned having a stomach, right? You invested in Blackstone, 2 funds at Blackstone Group in the US. And you didn't really have to do anything, right? I mean, you just put the money in, and you mentioned Vina Capital as well, one of the original private equity funds here in Vietnam, also did well. The return was good, wasn't smashing success, but you didn't have to stomach through that as much either. Maybe you can comment on that relationship as an LP looking at Vietnam. Should I put my money into funds? Both? Do my own investments? Share a bit about that.
So I made my first bucket of gold, right? The Chinese call my first bucket of gold in early 2000. So I put some money in Blackstone real estate. I put some money in Blackstone equity. I put some money in Sinven Fund, which is in Europe. And continuing onward, when I first came to Vietnam, I put some money in Vina Capital, Vietnam Opportunity Fund.
Okay.
So the funds are good. The funds, I think, like Wee Ping said earlier, just the speaker that preceded me, it gives you the chance to learn a lot about the dynamic, and I was able to attend to a couple of the Vina Capital investor conference, and I think I learned a lot. That's a good way to get your feet dirty. It's just that when I cashed out the company in 2005 in America, I want to come to Vietnam because I am first generation. I'm F1. So the risk taking is still fairly high compared to the second generation. And I came to Vietnam precisely for its high risk, high reward profile. And very quickly, I find that the better opportunity are in the direct investment. And the Vina Capital is it's a very good fund. I think the big fours are all very good. But they are writing very big check size.
Let me stop you right there, Calvin. You're on the ground, so you can make those investments directly because you live here, you work here. We can get coffee tomorrow morning if we wanted to. I can give you a ring. Hey, Calvin, write a check into my company. You could do it. But for those calling from overseas, from America, from Singapore, who do they rely on? Should they make those investments directly? Like rely on people like you to maybe co-invest? Should they go into the funds? What kind of I mean, you're sitting from a different perspective, obviously, but if you were to give feedback to them, perhaps.
Yeah. So this is the advice that comes. So I'm going to look a little bit forward now, as in the near future. I think the opportunity is really in the regional fund. I think the global fund are simply too big to absorb all the opportunity. I think a lot of the very adroit, some very agile regional fund. They kind of have a flavor of the rest of the region, and they're close enough. They're really literally one GP, one partner, or one co-GP away from launching a fund.
Yep.
I'm not well versed as to which fund is doing what stage of the game. There's no shortage of tech venture fund. I think so far I've made 4 investments in tech so far. Exit 1, beautifully, very happy, and 3 more on the three currently in my portfolio. And there's no shortage of venture fund. But other PE fund, listed fund, real estate fund, whatsoever. I think the regional fund, they know the area fairly well. They know the risk profile of an emerging tiger like Vietnam. They're simply literally one partner, one co-GP, one GP away from getting going on the ground. The barrier to entry currently is still relatively low. The cost of entry of setting up your kind of a minimally viable office or functional office is still relatively low.
Okay.
So I encourage more people to give Vietnam a close look.
And I just want to comment, guys, for those of you listening in, Lydia was mentioning just as we started the call that we were struggling at first to find a family office that not only wanted to share insights and could, but good ones, hopefully. But the reality is there's very few. And I want to touch upon that a little bit, Calvin, because there's a lot of tycoons here in Vietnam, conglomerates, I think similar scale to anywhere else in Asia, yet they don't really invest in tech companies. Maybe you can touch upon that, and perhaps in a way that you can showcase the opportunity for family offices not in Vietnam to kind of fill the gap. Maybe you could talk about why Vietnamese family offices don't exist in the same number that Singapore does in other places.
Yeah, and I do. Please give them the family offices here the benefit of doubt. It is a very new economy. I remember vividly the first flight I took back to Vietnam, just right after Clinton normalized the relationship between Vietnam and U.S. And as a USA citizen, I legally cannot enter Vietnam unless the relationship is normalized. So our modern economy is really only about 28-year-old, 29-year-old. And so the tycoon here, really, how their thinking is, their belief, their value system was really shaped before Vietnam was open. So we shouldn't use it against them. That's number one. So they're not quite integrated to the world in general. They don't quite make how to this thing called the financial structure. They are not so trustworthy. So they're really unwilling to hand over the millions of dollars to a direct company, much less a fund, which in turn dispenses to a direct to an investment. So it's really 2 layers of trust. So they're really trying to digest all of that. But I believe the biggest reason is still Vietnam's still a very high return environment. And these tycoons are still putting money in fairly good return. And of course, we are very much shaped by our past experience. Going forward will be quite different. And I think this lack of trust, this lack of assimilation to the global economy, the fiduciary relationship that Eric talked about earlier, I think that is non-existent in Vietnam. It rolled off your tongue very naturally. It rolled off. I know it's part of what you do, but it is require a big leap for the local people. So I think a family office organized the way that we expect it to be is really rare.
Okay, got it. By the way, guys, if you have questions, please drop them into the comments. We're going to move into the Q&A in just a little bit. We have one other question here that I'd like to touch upon. So Calvin, and for the audience here, you're very diversified. This guy even owns like a forest in Nha Trang. It's like a beach town here. I don't even know what that business is all about, but yeah, he owns a forest. So if you're into forestry, call this guy.
A plantation, a hardwood plantation.
Okay. How do you manage the diversity in your portfolio and the risks and opportunities that come with it? But also, if you can elaborate on why you chose technology to be part of that portfolio. How big is it? How small is it? Where do you see it going in the future as well?
So the investment to me in Vietnam is really all about picking on the person. It's picking on the horse. It's again, we just don't have a lot of data. We don't have a big enough field to where you can pick on idea. You can pick on sector. To me, it's pick on people. The country is fairly big, 100 million. It's big enough to stand on its own. You have a decades of state-owned company that are very big, they're not very efficient, they're not resource efficient, they're not capital efficient, and you have a burgeoning economy. So I saw some 18 years ago that what's missing is this middle size. You have the very big state-owned company that are doing very well. You have a very entrepreneurial driven country that give you all the small to medium-sized business. So what I noticed very early on is this missing of this middle-sized company that if I somehow deploy capital, if I somehow instill in them the corporate governance, package it in our package. When I mean package, I don't mean ribbons and wrapping paper. Package in the sense that giving it what is missing, so it is marketable, so the institutional and the foreign and the sophisticated investor know how to process it. If I can somehow bridge that, and how I do go about doing it is I spot talent. I spot a talent. I think good talent wherever they are, whichever space that they, whatever space that they operated in. And if I can spot them and give them the tool that they will do well. In fact, the slogan of our company is enabling and empowering early stage entrepreneur.
What's the name of your company again?
Indie Pacific. Indie is IN capital DE. It stands for investment and development. So investing is one thing. In Vietnam, you're just investing it. You cannot just turn away. You got to spend the time to help develop it. So hence the name Indie, INDE, D as in Investment Development Pacific.
I'm
starting
to think LP should invest into Indie Pacific.
Anyway, thanks for the plug.
You can message Calvin after if you're interested.
Thanks for the plug.
I want to touch upon the packaging comment that you made. So I'll give you guys my own example. So I'm Vietnamese American. I moved here 8 years ago, and coming from a Silicon Valley, I'm raised and born in Silicon Valley. Coming from that perspective, VC money is like unlimited.
Sure.
You have a degree from Stanford, and you get a VC check right away.
Sure.
But there's also systems in place to kind of like communities you mentioned, not even systems, sure, that kind of validate and support one another. I want to circle back to my first question a little bit and add upon it. Packaging, what does that mean to you? Like, for instance, in the bigger global scale, now we talk about ESG, like the governance aspect at least, financial discipline, reporting. Historically, and for those of you that have maybe had an experience in Vietnam already, that's really weak here. Even I'll admit for my company, it was pretty weak until about 2 years ago when we hired our CFO, and she's amazing. My CFO is like both my best friend and worst enemy. And I think you need that relationship.
You want that. You need that.
You need that. So maybe you can touch upon that. What does that packaging mean from your perspective? You say talent, you like to spot that out. What packaging that you bring as an independent family office?
So just for proper context, so earlier you talked about why I'm so diverse in sector. It's really about picking the right person. If the person that I believe in, that can generate a lot of value, that can return capital, that will treat the money as is his own money, then I'm willing to take the risk with him by going to a new sector. But Vietnam, you have opportunity everywhere. Just for a very just a quick synopsis, it was a subject of China for 1,000 years. It was a colony of France for over 100 years. It was a mile in the Vietnam War. In English, you call it Vietnam War. The Vietnamese call it the American War. It was smart enough for 30 years. Much of that 30 years, things just get blown up. Things wasn't get built. Then it went to communism, and you have a couple of decades of austerity. So just and things didn't open up until 28 years ago, as I said earlier. So you have a lot of catching up to do. So all sectors have room for growth. All sectors. So it's not about picking sector, and it's not about picking company with fund with a track record, because they don't have a long enough time. So it's about, so you have no choice but to pick talent. So having that context, and another context of that is that how do you package them? So the rule number one is, do I invest into a founder who is very poised, who's very articulate in English? Does it really have anything to do with him running his day-to-day business? And you say probably not. So then by requiring English only, we are cutting away out a subset of what I consider investable company. So how do I add value?
Let me touch upon that. You mentioned language. So for me, for instance, I speak native English. My Vietnamese is good. My team might be laughing at me right now.
Good enough.
Good enough. I can understand and speak myself. But for, let's say I'm a Singaporean investor, I'm a global investor, and I look at Vietnam, and I meet a founder, but I can't communicate with them in the same way that I could with a native English founder. Why would I invest in them?
So they're not investable.
They're not investable. Okay.
Then they are not investable from the prism of an institutional savvy foreign investor.
Okay. You have to rely on a local partner if you wanted to make those.
Yeah. How would you put money into somebody you cannot communicate with? We can talk about talking to them, communicating, building relationship.
I think
so then I investable. So very practical consideration that gets in the way of returns.
Right. I want to talk about also exits. You mentioned you've invested in 4 tech companies. You've exited 1. That one specifically was acquired by Line, the messaging app from Japan. It was also a media company, community company. And that was a number of years ago. Maybe you can talk about that experience to whatever extent you can. And, why I ask too is, and this is from my personal experience, not a lot of exits in Vietnam. Not a lot. You have a lot of money coming in, but not a lot of money coming out. So maybe share about that M&A experience and also how you foresee that developing the next few years.
So when I put money in, I seldom think about exit. Maybe that's me. By the way, as fun as Hao made it earlier, when he introduced me, that I never work for a fund. I don't know he said that as a way to take a jab at me, or did he say that as a way of saying that, this thinking outside of the box allow me to do what I'm doing. When I put money into the company, I really never think about exit, because if it's a good company, why the hell do I want to exit? I think partly because I really don't have a mandate, the time restricted mandate. So for the exit, we were able to exit to Line. I still maintain steadfastly that if you're number 1 or number 2 in your category, there'll be exit.
Yeah, there will be.
Then number exit. So it's really about number one, number two, and the economy is young enough that every one of my company that I'm putting in, there's a decent shot at number one and number two. So if you're number two, there'll be money for you. If you talk about general as a country, and you're talking about hundreds and 1,000, then tech in general, I think there's a tough exit because we don't have any pure tech that's IPO. And I think Silicon Valley, what makes Silicon Valley work so well is that IPO is a very viable path of exit.
And is it here?
Not for tech. Not for tech.
And maybe you can touch upon that exactly, because people ask me what my exit strategy is, and I tell them there's a few. You have IPO, you have M&A, you have just continue as a good cash flow business or fail. So removing failure from the option, what are those other three? And I think for the typical American company, let's say anything's possible. But in Vietnam, IPO, not for tech, maybe you can touch on that.
But a very high probable path of exit is an outright trade sale to a foreign entity looking for exposure in Vietnam. Vietnam is a really great consumer market. It's a great high growth market. Vietnam is a high return market. A couple of words on return, and for the finance people in the audience, you may want to know this little piece. Vietnam has a chronic high cost of capital country. For a couple of reasons. We have an inefficient economy. We have an inefficient corporate structure that is simply new. So because of that, cost of capital is quite efficient. The banking system is very inefficient in terms of how much of, if you measure how much of the profit they have to set aside for operation as compared to a better operated bank in a region, it's inefficient in that sense. So because of that, the country is used, the business in the country is used to rewarding investor and paying back investors a very decent return. So I think it's a very attractive country. And therefore, we number one, number two, number three in the respective field. It's a very attractive acquisition candidate for a multinational looking for making a country a in-country presence overnight.
So let's give the audience here a bit of a scenario. Let's say I'm an international company or a family office perhaps that wants to take a majority share, potentially controlling or whatever that interest is. And it's in a sector that I know a lot about, but I don't know anyone on the ground. Walk me through that investment or M&A decision-making process that they should consider in the Vietnam context. You mentioned founder. What about the books? What are some red flags to look out for that's perhaps unique to Vietnam? How about regulation? How about policies, FDI investments? The whole checklist is massive, right? But I'd like to give that snapshot to whatever extent you can in just a couple of minutes. If you were to check all the boxes, maybe someone will acquire your company. You never know. So let's.
It's a very loaded question.
I know.
It's a very loaded question.
I'm not curious for myself because if someone did approach my company, for instance, I want to know what the checklist is, right?
No,
I kind of know, but.
No, we all employ we all employ the same checklist. This is really it's not a big deal, but at the end of the day, everything works. I'll tell you why. If you take a motor, do you take a scooter? You take a motorbike?
Occasionally.
Okay. Yeah. So it's quite a hair-raising experience. The traffic is chaotic, things no rule. I told my son when he ride his motorbike in town, I said, don't pay attention to the lane. Don't pay attention to the traffic light. Just pay attention to the vehicle around you. So that's, by the way, that's a rule for survival.
Yeah.
So I
relatable to business here. Okay.
That's a rule for survival. I think there's a lot of shenanigan going on. I think there's a lot of headline making story. But I think at the end of the day, a crook when you see one. You got to eat with them, you got to sleep with them, you got to talk to them, you got to probe them, you got to put them in expect.
That's an interesting point.
It works. At the end of the day, you get to the finish line unscathed. But the traditional lane and red light will not get you there. So, but you need it.
Yeah.
You still need it.
So without naming names, it's all in the media, so you can just find it yourself. But there's some companies that have received tens of millions of dollars in VC, private equity money that have later been accused and rightfully accused of embezzlement to fraud. And American companies and are no they're not doing so hot either. I think like FTX and whatever, but Vietnam especially, because the recourse system is very unclear, especially for international folks. I've heard so many horror stories of people like disappearing. They'll take money and disappear. But what do you have to say about that? I mean, I'm sure it's even happened to you at some point in Vietnam, where maybe they don't have boots on the ground to like check that out. Can you comment on that?
Yeah, it happened. And every time I read that, how, there's a part of me that basically, there's a part of me that got crushed.
Right.
It makes Vietnam look bad.
Exactly.
It makes people like me trying to make things work, trying to put Vietnam on put it out in Vietnam. It sets us back a little bit. But I think human greed, has been with us for as long as greed, and you said Silicon Valley is no exception. What makes it very bad in Vietnam is that how people are willing to walk away for not a lot of money. So the bar is a lot lower. What makes Vietnam look very bad, and so that's an example that's one of the checklists that's in my list. Is this person's gonna get drunk by access to money? Is this person gonna get drunk by access to power or the podium? I've seen people get drunk in front of podium, meaning that now I get interviewed, by the media, by the civic, etc.
You get
now I look
fame or the
and it happens a lot. You have a younger population, and they get straight from that a bit easier than, let's say, somebody who's been at it. Vietnam has not had a lot of down cycle. So when down cycle happen, they just don't have the what's the word to use? The thick-facedness. Vietnamese call it bang lin. I cannot think of what it is in Vietnam. They don't have the stomach to deal with it, to down cycle. They just basically they disappear. They thinking disappear is actually easier as opposed to make a phone call. One of the guys in town that I respect a lot, I love him a lot. He said the most difficult moment of his life is to make several phone calls telling investor how he squandered $1 million. That was the most difficult call, and he lived to tell me the experience, and I respect that a lot. And you cannot find. Oh, here's a VQ. He's a overseas Vietnamese, well trained, top brass university. I wish all the local founders have that courage.
All right, a follow-up question. I love scenarios, hypothetical situations. So I'm an LP, I've got $5 million. So aside from giving 1 million to Hustle Fund, I don't work for them, but give it to them. And I'm looking at Vietnam. How should I deploy? Should I deploy all that 4 million into Vietnam? And how should I do it? I'm from the outside. I don't want boots on the ground. I'll come once a year to say hello, shake some hands, and meet some brilliant people. But I'm not going to be there. Let's just be realistic. How would I deploy that money? VCs, PEs, direct investments, what kind of industries, tech? How would you play around with that cash if you were that LP?
How I never make money recommendation.
Okay.
I never make money.
That's a disclaimer. That's a disclaimer.
But hypothetically, I'll say this much. I came to Vietnam on a real estate mandate. I know a lot about real estate development. I think I know a lot about it. But I think the Vietnam real estate market went ahead of itself.
Went ahead of itself.
It went ahead of itself, and I think it's even with the current correction, I think the real estate valuation is not keeping in pace with the earning power of the people. It does not come well in the regional real estate. Any way you look at it, I think it doesn't make sense, except for a deal here and there. So I rule that out.
Okay.
The listed stock market, I think it's we're in a down cycle. Vietnam is very cyclical, but I don't think it's gonna go well.
Okay.
But perhaps I think you're asking a wrong person. You're talking to somebody who's long in Vietnam. I'm very biased in Vietnam. I vaguely remember Warren Buffett said some 2 decades ago about China, this thing China that few Americans know about. 2 decades ago, just like now, few people know about Vietnam. And Warren Buffett said something along the line of, I just choose the 10 best company in China. I just basically put 1/10 of my of the money I want, and I just don't look at it. 10 years later, you're making a lot of money. I take that line from Warren Buffett.
Okay.
You have a low, you have an economy that has a low starting point. You have a very entrepreneurial environment. You have the young people who are hungry to do better than their parents. You have the work ethics. You have a government that's really trying very hard, to assimilate into the global economy. Yeah, of course, the economy, the government will stumble here and there. The economy will have downturn here and there. But I think if you look at any, depending on what time horizon you're looking at, 10 year, 20 year, 30 year, I think I'm very bullish.
Okay. Yeah, it reminds me of a quote that I recently heard. I moderated an event a couple months ago with, what's his name, Chad Oval.
Oh, yeah.
A partner at Mekong Capital.
I love Chad.
One of the more successful private equity firms here. They set up shop some 15, 20 years ago, I think. And he made a statement that I really stuck with me. And I think for you guys here today, hopefully it will as well. I asked him 10, 15 years ago when you guys first raised the first fund, let's say you had a 1 hour meeting, hypothetical situation, 1 hour meeting with an LP. How much of that 1 hour meeting would you spend selling Vietnam versus the fund? And he told me it would be 55 minutes about Vietnam, 5 minutes about the fund. And I asked him, what is it today? And he said, 55 minutes about the fund, well, 5 minutes about Vietnam, 55 minutes about the fund. So it's kind of switched itself. So I think that's represents kind of what you're trying to kind of share here today, Calvin, that people are bullish about it, and investors are also getting more understanding and access about this place. I still admit, though, the content is pretty poor in research about Vietnam. Let's be honest here about that. But I think the track record in some sectors is there. The sophistication of some investors is quite polished here now as well, either smaller shops like yours, independent ones, or sophisticated funds. And it's helping to ease kind of people's understanding about this place. So let's see. I'm also very biased, but I'd love to hear from you guys how you feel about this place and what you'd like to know more. We're going to move over to the Q&A in just a second. So Lydia, if you can drop some in the Slack, I can pull a few from the red logo just kept popping up, so I've lost track of all the questions. If you can just drop a couple for me, that'd be great. Love to hear from you guys about your questions about Vietnam. Calvin, is there anything else you want to share before we head over into the Q&A about your investment experience here?
I will weave that to the example you say about Mekong Capital and Chad. So I met Chad probably 15 years ago. And Chad, so Chad's an American, as an American. And I believe Chad has been in Vietnam for 25 years.
Yeah.
But what's unique about Chad is that he embraced Vietnam. So he saw Vietnam as the place he wanted to be in Vietnam. He lived and breathed Vietnam before he told the Vietnam story. I think the Vietnam story, you got to be comfortable with Vietnam as an operator. What works. So my comment is that do what I do, which take all the tool, all the know-how, all the stuff we learn from whoever you are. In my case, America, you apply to Vietnam. but not indiscriminately. You got to respect the local culture. You got to respect the local people. When I say respect, I don't mean no totem. I mean, you need to customize it. You need to localize it. You need to juice it up. You need to, and in the process, there are some stuff you have to throw away. There's some, and you have to be willing to pick a few more tricks on board. I think if one takes the time to do that, and the beauty about Mekong Capital is they do that. And that's why they are #1 performing private equity firm in town.
Okay.
And so basically, hang on to what you learn, but respect the local practice, and basically adjust it a little bit, then juice it up.
Very good. Okay, we have a few Q&A here, guys. And if you have any extra, you can just throw them in the chat. And even if we don't get to it, perhaps Calvin and I could answer them later. We'd love to hear from you guys, everybody. So,
Sure.
All right, Lydia shared a couple questions here, so I'll get straight to it. A lot of family offices have been visiting Vietnam, from all the way from Belgium to Singapore to Hong Kong in the last couple months. I've met all of them, and they're pretty interesting people. Like, why are they investing in Vietnam? It's really random. Like, one of them is a Belgian family office, and they invested in this like deep water port in Haiphong. Another one is interested in acquiring F&B chains here in Vietnam. It just Belgian, who would have thought, right? So my question for you is, Calvin, from the audience, what are the steps and processes that potential family businesses should take to establish a presence in Vietnam? I interpret that as like, should they hire a representative to cover Asia? Should they hire a representative to cover Vietnam, a portfolio manager perhaps? Should they seek an advisor to help guide them through this place instead? What are your comments on that?
That's a loaded question. It's tough. It's a very tough question for me. I think everything that you mentioned serves the value. I think you need one of the big firms to kind of give you the lay of the land. I think you need a local representative that basically that earn your salary, so they know who they pledge their loyalty or their responsibility to. You need that. But I think finally you're probably better off with a strong local partner.
Okay.
You know,
when you say
local
partner,
partner
someone
who's
that-
skin on the game.
Skin on the game too.
Who's skin on the game, who somebody who can internalize that your success equate their success. I think you need all the above.
Okay. Calvin's pitching himself, guys.
No, I'm not. No. I'm not. If I pitch myself, it's simply because I guess I eat my own dog food.
Yeah.
Because I live what I live.
So
I love dog food, but
seriousness, you should contact him.
Yeah.
How about okay, this is a good question. I can answer it as well, but I'd love to hear from you, Calvin. How do early stage startups access capital in later stages in Vietnam? Do they have to go outside to raise capital? Is there follow-on investment inside the country itself? What does that look like? I kind of know the answer, but I'd love to hear from you, Calvin. Yeah.
I'll answer, but
sure,
promise me you.
Yeah, I'll add on. Yeah.
No, I think there's been. I think many of the funds have good feet in the ground. Of the few investment that I kind of know firsthand. Oh, by the way, besides my direct investment, I'm an advisor to Antler Fund.
Okay.
And
Antler
Fund. And I make myself generally available to the startup community because I know how valuable it is, how important it is. For those people to have access to information. There's a bit of me. There's a young man in me that's always wished that there was somebody else that helped me when I was earlier. Then I felt like I need to pay forward. I need to pay back.
Sure.
I need to pay back. So I'm generally available for 1 hour coffee here and there. My view is it's actually the opposite. I really think there's too much money chasing too few deals in Vietnam.
Too few deals.
I think so.
Okay.
I think some of the startup I look at, I mean, some of the stuff that they're talking about, it's like, holy cow, life of a startup founder is pretty damn good, compared to my old days.
Okay.
I don't think there's a lack of access to capital. That's my view. What's
Yeah,
yours?
I would have to agree. I mean, I think for my company, we've raised a couple million US dollars. And I mean, fundamentally, I believe in my business, of course, right? But I was quite surprised how quickly we closed these rounds and the lack of due diligence. I mean, we're pretty good, okay, guys, but I say that as more of a keep your eye out in Vietnam because there are phenomenal deals, tech and otherwise. But I think people get so excited at the first person they meet. They're like, oh, oh, Hal can speak perfect English and, he did this and did that. And yeah, please, if I do call for investment, I'd love to hear from you guys. But you're right, there is very few deals and too much money.
I think
A lot of people want to come into Vietnam and invest. And oftentimes they're less so now, but they put their money first thing they need. And I'm a victim of that mentality too. When I first came here, I got so excited that I put money in this. I lost everything within a year, not VietCetera, something else. Yeah, I would have to agree with you that too much money across the spectrum.
I want to latch on the word that I believe Dave, I think Dave used it several times in his session, the noise versus the signal. And for the electrical engineer in the room, there's a signal to noise ratio. I was an electrical engineer. So there's a lot of noise. There's a lot of noise on the ground. And it drowned out the signal sometimes. I think so because of the barrier of language, the barrier of language, some of the founders are more polished than others. Some I think are too polished for what they do. Some are very good. They're just not able to present. So I think the noise and the signal it's just horrible. In many ways, I really understand the challenges some of these fund operating in town. It's tough.
It reminds me not of a Vietnam or Southeast Asia example, but I was recently in Dubai a few months ago, and I met a friend who works at Uber there, and he was telling me how beware of people that say, oh, I know the Sheikh, or like, I know the Sheikh's family or something like that. Sheikh is like the king of the United Arab Emirates. Because like apparently everybody knows the Sheikh. And I think here in Vietnam, it's kind of the same. Because it's a small community.
Exactly same.
I think it's easy to get, I don't want to say manipulated, but convinced that someone's legitimate or a company's legitimate just because of social media posts or they got in Forbes 30 under 30. I think that the memes on Twitter nowadays, right, about Forbes 30 under 30 is that it's like Forbes 30 under 30 for fraudsters or something. I mean, that's not my opinion, that's Twitter's, but I think I would definitely have to agree that people kind of have to look out, but there are hidden gems, and you proved it with your investment with one acquired by Line, among other investments. I have a follow-up question here for you, Calvin. How do you mitigate concentrated country risk? You're all in Vietnam at this point. Maybe you have some investments in the States, so I don't know, but most of your money's here now. How do you mitigate against that?
I don't. So I'm American. So my 401k plan, my wife's 401k plan, my home is in the US. So that's already built-in diversification. I don't. So so very early on in my entrepreneurial day, I kind of set aside for the children. They can study whatever they want. They can change major whatever they want. They can choose the school that they want for as long as they want. So I took care of that, and I took care of to make sure that my wife doesn't have to stress over work. By that time she had been working for 20 years. So so once you take care of that, and I live very modestly by choice. I guess it's from my modest family upbringing. So to me, everything's play money. So this thing about country risk doesn't cross my mind.
Okay, that's great.
Having said that, I took care of my family and I got my house. So
yeah,
easy for me to say.
Sure. I kind of have to agree with you. I think, let's say my parents who are Vietnamese Americans now, they live in the US for 30, 40, almost 50 years. They're always hesitant to invest or like, let's say buy an apartment here because of their experiences in the past. Obviously that was a very long time ago and things have changed. And I'm thinking like, you only have one life to live. And I think risk management, for sure, you have to do it. But with that said, why are you even here building a business in Vietnam if you're trying to mitigate risk at the same time? Because the people that try to mitigate risk 30 years ago, well, they're not here anymore, or they just never made an investment. And yet the ones that did, like the Nikon Capitals of the world, they did very well. So I think just given where Vietnam is going and the risk management here, yes, every country has risk. But I do feel like from my perspective, even in the larger Southeast Asia spectrum, Vietnam is very attractive from a risk management point of view, because let's take policies and government. It's fairly consistent. They like to get things done. And the thing is, they want to keep the people happy. And so they'll focus on economic empowerment and development. And yes, of course, there's things that need to be improved always. But compared to the US, where everything is like in standstill, and you have the far right and the left, and you don't even know what's in the middle anymore. I think Vietnam is kind of in the middle overall. And they're very good at Vietnam as a country, very good at being friends with everybody. Friends might be an overstatement, but just friendly, meaning, geopolitical concerns, China and US, they're friendly with both, largely speaking. They want to be on top of all the problems and get ahead of the game a little bit, I guess you can say. I've got time for one more question, guys, and then we're going to wrap up here. And this is a question without, I don't know if you can name names for this one. I think people are trying to find their co-investment friends in Vietnam. Who are the people with the best track records of angel investments in Vietnam? And if you don't want to name names, because I'm sure, you can ask us privately. I think people would love to get in touch with these people because they do have the deals, including him.
Yeah.
And if without naming names, why do you think those people are the best angel investors here?
Your thoughts, okay. I know exactly the question. The country-specific fund, there aren't that many.
Yep.
The country-specific fund, aren't that many. I've been involved. I've been invited a couple of times to be a partner for the Vietnam Tech, the Vietnam partner. So I look at the problem is that you just don't have a long enough history to say anything definitively. Having said that, there's a name in my mind that I'd love to share one-on-one with anybody. On the one-on-one, not their claim to fame is that they are best performing, but unfortunately, I don't think the person can say that today. And when the person made a comment, it was a very short track record. There's not a big enough universe of information to comment on that, because and then part of it is because really lack of liquidity. A lot of, so it depends on how you look at it. Is the valuation itself suffice, or is it cash out?
So it's not even about track record necessarily. It's just like, who's the best person to talk to? Who's the best person to invest with? Because track records just aren't really there yet from an angel investment / tech perspective. I think that's
but there's good people on the ground. There's good people on the ground.
Okay.
But in the PE world, I think Mekong Capital is indisputably very good.
Okay, well, there you go. That's it from Team Vietnam. Everybody, thank you for joining in today's webinar. I hope you learned something. Calvin and I, Hao Tran, Calvin Lam, we're both on LinkedIn. Connect with us, drop us a note, give a check as an LP to Hustle Fund. I think they'd appreciate that as well. I don't know if you've been raising, but I just make that as a comment. Lydia, over to you. Thank you so much, everyone, for tuning in.
Lydia, I want to cut in. Thank you for lowering the bar and let me to be your speaker today.
Oh
Thank
my
you.
goodness.
All right,
People in the chat are commenting what an incredible conversation this has been. They're just amazed at the breadth and depth of this interview. So I think we've been just very, very lucky to have you, Calvin, and you, of course. So thank you both so very much. And, you covered a lot of the questions from the audience. I'm sure there will be more. People have been asking how to connect with Calvin. I've been giving out the LinkedIn. Is that good enough?
Yeah, please. But by the way, they say that behind a good speaker is a very good moderator, a very good interviewer. So no need to need to say more than that.
Yeah, Team Vietnam just builds each other up. I love this. And to be quite honest, I mean, as a person who doesn't have as much insight, it's been incredible to learn about the ecosystem. I've heard so many things, but this has just been like really a fact-checking kind of mission I found this interview. So thank you both so much. Really appreciate you being here. I'll let you log off now and go on with the rest of your day. I know it's nighttime for me. I know people have been with us for 3 hours. Thank you, everybody. All right. See you, Hal.
Lydia, see you in
See you,
Canada.
Calvin.
Yep.
Take care.
Yes. Yeah.
Guys, we're done.
All right.
Bye-bye.
Bye.
Thanks, everybody.
Bye.
Thank you, Hal.
All right, everyone, I am going to jump in and say just a couple of points for anyone who's sticking around. Thank you, first of all. I can't believe you stuck with us for 3 hours. If you did not, and you're like, wait, I missed the first session, second session, don't worry, the recording is going out. Thank you, Ming. I really appreciate all of you being here. I'm gonna do one more plug because yes, we do live events, we do webinars, but we also do live events, and the live events are really special. We love connecting with people in the region, and this is our first big event in Southeast Asia because we know that our community there is very strong and we want to meet them in person and just connect better. So if you want to be on a beach with us, go to camphustleasia.com. I'm going to send out an email as well, letting you know there's going to be a special promo code for you. Please join us. And if not, there will be many more webinars. We're hosting another investor event in a month's time. So if you want to keep in touch with us and keep seeing our events, please go to hustlefundvc.com and click on events. And there's a sign up list to just keep in touch and make sure that we're updating you on any events coming up. But otherwise, follow us on social and you'll see more of that. I'm going to stick around. I'm going to stop record. And if anyone has any questions, I'm just going to answer them on a one-on-one basis around, any of our events or Camp Hustle Asia or anything that was covered today. I'm happy to answer any questions. So thank you. I know you'll be logging off. I appreciate you being here and well, chat with me if needed.